This economy has outperformed this year, both in terms of growth and bringing inflation down.
Inflation is going to come down faster, and that would allow the Fed to cut in 2024.
They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate.
The labor markets are normalizing.
I think it'd be really unlikely that they're going to move at the next meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get back to work. Live from New York City this morning.
Yeah.
Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market negative by 0.2% on the S&P 500, following the biggest week of gains on the S&P going back to June. TK, the happy talk begins in September. Goldman cutting their recession chances to 15% after a week of pretty decent data to keep this Fed on the sidelines.
There's some interesting research over the weekend, the long weekend here in America, and certainly Goldman leads the way with that lesser recession call. What's interesting about it, John, it buttresses up against a China basically in policy chaos. And so to the global tone, I'm really unsure of where we go, other than Jerome Powell has a spirited leadership in economic growth right now.
Ben Laidler, eToro, it's as good as it gets. The bulls, Tom, still bullish.
Well, he's still bullish. It was a very nuanced note, actually. And Laidler says it is as good as it gets. And the nuance there, John, is that we peel away and maybe we get a lesser. And then he goes to a soft landing, which I still don't know what that means. But
yields down, tech stocks up.
Yeah, soft landing is when Brammo comes back from her sabbatical.
Rainbows and unicorns.
Yeah, you know.
All good stuff.
She saw them on the slopes.
Brammo returns less bearish from vacation. Is that how this works?
That's on that.
Can I just say, first of all, nobody's very that happy that the summer is over. Let's just be honest. I don't know if you guys have had those conversations with people. There's this feeling of just like, ugh, what are we heading toward?
It's not over.
It's, what, the summer?
Oh, it's in the 90s in New York City this week.
Are you wearing white?
I'm holding on to summer.
Are you going to wear white pants?
I don't wear white pants anyway.
Okay, that's a fair point. Anyway, I do want to say this. I think that probably this sums up my mood best. Diane Swank of Grant Thornton put it best. And she said, there are a lot of people who have decided an incredibly complex economy can be explained with half answers and a lot of armchair quarterbacking. She's confused, right. And she's really right. And it's basically a stew, and you have both sides hunkering down for what may happen at a time where we are on the precipice of understanding some of the rate hikes.
It's a stew. It may be a toxic brew, but we're doing it here in the heat. For all of you worldwide, we've really had a spectacular summer. And, John, as you mentioned today, summer comes late here in New York. I did it to Celsius. I mean, it's summer, and, it's 33 Celsius, which doesn't translate in early morning
It's going to be hot this week in New York City. That's a beautiful thing.
Still summer.
It's not a beautiful thing.
The winter's an endurance. I don't want to wish away summer and embrace fall. I just
ask Lagarde. September's terrible.
September 14th, big decision for them,
big
TK.
Decision.
Big decision. They're stuck between a rock and a hard place. For the Federal Reserve, it was pretty clear. Coming into last week, the data needed to tell them why they needed to hike. It failed to do that, Tom. Based on every single jobs print we got basically last week, this is a Fed that's encouraged to stay on the sidelines unless you get a blowout CPI number on the 13th.
On the 13th is the CPI number, but to all of this, it's just the transatlantic disparity there, and it folds over into a stock market that's resilient. We started, this is like New Year's, John. I mean, in America, the day after Labor Day is just like January 3rd or that. It's a whole new year, and to start with Chiavarone is going to be really constructive.
Looking forward to catching up with Steve around the table with us. Equity futures on the S&P, just to get you up to speed on the price action, just slightly negative on the S&P. We're down by 0.2%. Yields are higher by 4 basis points on a 10-year at 4.22. Yields aggressively lower on the front end through the last week or so, Lisa, off the back of that economic data in the United States.
Just amazing to see 20 basis points just plunging on the heels of some of that. This week is going to be a quiet one, but there are some interesting points that are coming up. Wednesday in particular, a big day today. At 10 a.m., we get ISM services data in the U.S. for the month of August. Very curious to see whether we see a rollover at all, whether we stay above the 50 mark, which is above recession, even as we see contraction over in Europe. We also get the Fed's Beige Book, and we're going to hear all about the effects of Beyonce and Taylor Swift and everything else, the Barbie movie, all of those things I expect to factor in quite significantly to the Beige Book. Throughout the week, tons of central banks speak. Who isn't speaking? ECB's Christine Lagarde speaking today, Bank of England's Andrew Bailey, Bank of Canada's Tiff Macklem. I mean, go on. And the Fed speakers, John Williams speaking at a Bloomberg Markets conference.
Auctions, we missed
They're
you.
T-bills. They're T-bill auctions that are coming out today and throughout the week. But a lot of it will be interpreted in the price action of these central bankers. And then Thursday, this is sort of the most under the radar event of the week. week, and that is the striking action that could potentially happen around the world. We have what's going on in Detroit. That's next week. This week, Chevron's LNG export plants in Australia, workers there have threatened to stop work if they don't get a certain agreement. And this will affect certainly prices for China and some of the other Asian nations, but also in Europe. And I just wonder how much is this significant?
How does that affect Europe? This is Western Australia off Barrow Island, north of Perth. And how does LNG in Australia affect Europe? I don't get that.
There's a concern that it's going to create a pricing war because essentially you're reducing supply. And even though there are some well-stocked countries right now, later on, it could elevate prices. We've seen some price pops on the heels of this. Either way, again, it points to that stagflationary concern that people are experiencing with Europe.
The stealth rally in crude. I'm with Lisa. The energy market just not on the radar enough. We're talking about highs for the year.
Totally
in Brent
agree.
yesterday.
Well,
Tom, getting closer and closer to the 90s, 88 right now.
We heavily covered this on Friday when both of you weren't here. 88.41 on Brent crude.
Well, we thought after you took half of August off that maybe we should get a long weekend. Steve Chiavarone, head of multi-asset solutions at Federated Hermes with us around the table. Steve, good to see you.
Good
I'll
morning.
drop the mic and walk away. This rally, do you think it's got legs?
Yeah, well, I'd like to start by saying I'm going to hold on to my white pants and summer as long as the weather will allow me to, although it's not pleasant. No, look, I think the rally does have legs. You know, this argument over recession or not, right? Are we headed for a recession? It's kind of hanging like a sword of Damocles over folks, I think, in a lot of ways, and keeping people from being able to be tactical. And if you look at things from a Fed cycle perspective, you have a Fed that was hiking. They're either on pause or close to pause. Markets rip when Feds pause. In fact, each of the last times that the Fed has been on pause, you've seen an S&P hit a new all-time high. And I think that's the path of least resistance this time around. Now, and you pointed to the oil market a second ago. You know, you don't have energy prices rallying to year-to-date highs on the verge of rolling over in the economy. Now, that doesn't mean that rate hikes won't bite. It doesn't mean that the long and variable lags aren't there, but we're just not there yet, and I think the rally and the economic strength still has legs for the time being.
You add huge value in this thing called asset allocation, which I'm pretty suspect on. I think it's a great marketing tool, to be honest, but you really deliver. Go through the process right now of how you would reallocate a typical investor who's been in the market. Maybe they're up a little, but boy, they're not up like NVIDIA.
Yeah, I think the first thing that you do, and I think the biggest value we can add right now is keeping folks from getting seduced by 5% yields in cash, right? That's been a stalwart over the course of the last year. It's an attractive yield. But again, looking at those Fed pauses, on average, you'll see 10-year yields fall 0.75% to 1%. Hadn't happened yet. I wouldn't rush into that, but starting to lengthen duration. We think that's an important move right here. And then equity market returns again. We think we're in a period of time where inflation's moderating, growth is resilient. Could storm clouds form, 6, 9, 12 months away? Sure. But until you're at a point where you think the Fed is on the verge of cutting, and we think we're at least 9 months away from that, we think there's better returns to be had in both equities and bonds relative to cash.
How long can the U.S. economy and U.S. stock markets diverge from the rest of the world, where you see China slowing down with data overnight, you see Europe basically facing stagflation, and yeah, the U.S. keeps chugging along. But in isolation, is that really plausible?
Well, think about it this way from a market perspective, Lisa. When growth is most scarce, growth gets the best premium, all right? And if you're looking for growth, you're looking at the U.S. and you're looking at U.S. growth stocks, right? I mean, that are kind of producing their own growth. And what you've seen over the last decade, and I think you're seeing it again right now, is when economic growth is subdued, when the rest of the world is kind of softer, people flock for that growth. And where are you going to find it? You're going to find it in the U.S. Tech is 18.5% more of the there's 18.5% more tech in the S&P 500 than any other developed market index. That's where you have to go for growth, and I think that's why you see the valuations where they are right now.
And this is what's left me confused, others too. Growth hasn't been scarce in the United States. In fact, this rally's been built on upside surprises.
Yep.
And now we're sitting here suggesting that when growth starts to disappoint, we can carry on rallying. Can you make sense of that for me?
Well, I think it's a matter of degree right now. And so what you've seen is growth has started to moderate in the U.S. You've seen the surprise index start to roll over. You've seen all of last week was a set of softer prints. But it's moderating at a pace now where no one's kind of spooked by it, if you will, right? It's kind of a soft moderation. It's allowing folks to at least believe for the time being that this is softening consistent with a return to some trend, a soft landing, if you will. That pace becomes more important. Bad news is good news when it's just a little bit bad. If it starts to deteriorate too quickly,
just say it.
then the
Goldilocks.
market gets worried.
You want to call it Goldilocks?
No, I wouldn't call it Goldilocks. I would just say that it's moderating at a pace people are comfortable with. It's a tempering process as opposed to, an ice bath.
Are you pushing back then against the idea that for this rally to be sustainable, it has to broaden out?
No, I think it does broaden out. I think it does. I know I just talked about the kind of exception of U.S. growth, but I think what you'll see is that where we had weakness last year, the most severe weakness outside of tech, was in some of the economically sensitive cyclicals, where valuations are not nearly as stretched. If you're really pricing out recession risk like Goldman did this morning, well, then there's energy stocks and materials and industrials and more cyclical areas of the market where I think you could get some revaluation higher. I think that's the next leg.
So in a second leg of a bull market, do you imply that we broaden out from the 7 or 8 stocks that have been wonder stocks?
Yeah, that's one of the, you talked about asset allocation. Within the equity market, that's our big bet. Our big bet is we are underweight large cap growth and overweight essentially everything else on the idea that you're going to broaden out here.
Okay, let's get Deborah Cunningham upset this morning. Where are you on 60-40? You said cash you don't like. Where are you on 60-40?
Well, I wouldn't say we don't like cash, but we're working down high cash levels. And that's just, I don't want to get in trouble with Deb Cunningham. But look, I think what you see is on the fixed income side, given some of the storm clouds, you don't want to be heroic. So you're starting to lengthen duration. We're underweight credit. On the equity side, this idea of broadening out. And then just slightly overweight equities. But again, we think if you're in a position where you're at 10, 15, 20% cash, you really need to start working that down. One, because there's better returns in equities, we think, in the short run. And if the storm clouds do materialize, you're going to want that traditional fixed income kind of bulwark.
Any of your clients starting to worry about nasty politics on the horizon in 2024?
Yeah, we're starting to get those questions. We do a kind of re-election dashboard, which looks at economic circumstances. Right now it looks good for the incumbent, but there's a lot of uncertainty. And then you throw in the idea that, you may have one of the party's nominees on trial the day before or after. I
do wonder whether we've really thought through how messy this could be.
This could be really messy. I mean, I think it's so far out that folks don't know how to price it in. So if you don't know how to price it in, you don't.
Come on. The Wall Street Journal poll released in the last 12 hours, I think.
I've got it on my screen right now, Tom. Brutal.
Brutal, but I mean, we've had these fractious times in American politics, but I think I can say maybe other than Alien Sedition, 1802, John, we have not had it more brutal, more uncertain, more disparate. The polls are shockingly
73% of voters said they feel Biden is too old to seek a second term.
73. That's a big number, John, in America.
Two-thirds of Democrats said Biden was too old to run again.
Well, and that's the possibility. The possibility is that we don't know the nominee of either party at this point, which adds another level of uncertainty here potentially. So this is going to be something I think as you get in the back half of this year, well, the last quarter of this year, as you will, and then the next year becomes a bigger issue. We'll say disparate. You've got totally different views on the markets. You have totally different views on how to run an economy, and a ton of candidate uncertainty. It could be fuzzy next year on the political front.
Fuzzy.
The CFA level 4.
Steve Chiavarone of Federated Hermes. A rally that's got legs and a fuzzy 2024, Tom, just around the corner.
A fuzzy's uncertainty, and I really wonder what the bet is in the market. I think retail maybe's piled in. They're all up. They all own Apple to their eyeballs. But the bottom line is I can't get a handle on the gloom level right now. Part of it is Lisa was gone for 3 weeks. But, I just can't get a handle on the worry in the equity market right now.
The data's cooling. It's just not the Arctic or freezing cold. I think that's the way Steve put it. What did you say? Tempering.
Not Goldilocks.
It's 33 Celsius.
Not Goldilocks.
I have no idea what's up.
Don't use the G word. Kelly Kaminsky of Alpha Simplex coming up in about an hour on why Steve's still short this bond market. From New York City, good morning.
There are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. Folks, in this Labor Day, let me tell you what we're celebrating. We're celebrating jobs, good-paying jobs, jobs you can raise a family on, union jobs.
President Biden at a Labor Day rally in Philadelphia over the long weekend. TK, this is how you have your cake and eat it too. You get to say you love unions at the same time union membership is so low it doesn't cause you a problem.
Oh, yeah.
That's the situation in America right now.
I mean, I don't have the numbers in front of me, but basically we've atomized the public, and particularly, John, we've atomized the union labor, I should say, away from public service. People that are working for the greater American bureaucracy are in unions. How many people outside it are in unions?
David Kelly at JP Morgan said it to you on Friday, Tom, going into the payrolls report, made the point of how much worse things would be in this economy if union membership was as high as it was back in the 70s. And this is what I mean, having it the best of both ways. You can go out on the campaign trails, say you love unions, all that good stuff, and at the same time membership's so low, Tom. If membership was high, you'd have a very, very different problem as the President of the United States right now.
Drag us over to Europe, which you've got your encyclopedic on, John. The answer is it's not like America over there, and that makes for a lot of rigidities within United Kingdom and continental Europe.
I would say same trends,
labor.
though, Tom, over the last few decades.
Really?
In terms of union membership.
Atomization?
Similar trends.
Okay.
Similar trends.
Okay. Well, there it is, and we will begin today, and we do so the political... See, when's the next debate? I don't even know.
The 27th.
Nailed that. September?
Fox Business, I believe, yeah.
September 27th.
Yeah.
Same crew.
Hosted by Mr. Varney.
Same motley crew.
Stuart Varney hosting that one, Tom.
That's good.
Yeah,
Stuart will kill it. He'll be complete on it. We're going to be complete right now with Wendy Schiller, director of the Taubman Center of American Politics and Policy at Brown. Truly one of our most popular guests. We get huge response when she's on. Wendy, let's go to the images that we saw on radio. It was the president doing what he does, marching around with a mic, baseball cap on, hearkening to a union that he knew in eastern Pennsylvania long ago and far away. Don't they vote for Trump now?
Well, there's a lot of mixed voting in terms of unions, right? So if you think about the Teamsters, for example, they lean a little bit more Republican in their voting, but a lot of other private unions, particularly in the local level, vote for Democrats because they believe Democrats will spend money on things like infrastructure, which means construction, which means jobs for them. So it depends on the sort of local balance on where the jobs are in terms of private unions. You're absolutely right. About 7%, a little over 7% of the private sector is unionized, but public sector is still in the 30s in terms of unionization. And that can really matter in some of these key swing states. When Republicans go after unions, go after labor, they go after public employee unions, that can cost them votes. So Biden's sort of skirting a line, private labor, but also public labor unions are very important coming down to the election.
Politically, do you see a rekindling or rejuvenation of unions moving from that 7% statistic higher, or is that just wishful thinking on the part of union types?
Well, I think there seems to be a concerted strategic effort for unions to branch out, things like college campuses, for example, unionizing undergraduates, unionizing graduate students. You may think, oh, well, that may not matter on the margins. However, that's a group that is still really ripe for picking in terms of votes. And it's certainly a group that the Democrats need more than the Republicans to get out the door. So every time you have a new union agreement or a new people coming into the union sphere, that's a pretty much guaranteed vote because unions are excellent still at getting out their base to vote.
Wendy, it seems like yesterday's speech did a number of things. It did highlight the union membership. It also highlighted the fact that there has been more union action recently without the strikes that could potentially be a liability. But this is also what Biden said. We're turning things around because of you. When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. How much is President Biden trying to galvanize his campaign by going after former President Trump with the assumption that he will be the person he's facing off?
Well, Lisa, I would argue he hasn't done that enough yet. And also just to show Biden out on the trail, he can walk, he can talk, he's clear, he was energetic. I mean, given the most recent polling that has people really doubting his age and doubting his capability, the more he can get out and show that he's still vibrant, the more he can mitigate those kinds of concerns. So I think that's a really important part of this strategy. And also, if you think about some of the things in the most recent polling about Trump's job performance in office, it's relatively positive. So, the COVID after effect, which some people argue cost Trump the presidency in 2020, that seems to be diminishing for Trump. So, absent the indictments, there might be a rosier glow on how Trump's presidency went among average voters or independent voters. That's a real concern for the Democrats, a real concern for Biden. He's got to remind people of what that administration really was like and why they rejected it in 2020.
Does President Biden have any chance of winning if he's not facing off with the former President Trump?
Lisa, that is the Republican Party's existential question. You have to believe that the negatives associated with Trump, particularly among independent voters in swing states. And remember, some of these swing states have swung a little more to the Democrats in recent elections, at least at the gubernatorial level and the Senate level. And when you think about that, that's their issue. Would they do much better if Nikki Haley was at the head of the ticket, or even Ron DeSantis, even if he looks shaky, or even Tim Scott? I'm not sure if Vivek Ramaswamy is the guy to go to, sort of Trump light, so I'm not sure that does it for them. But if they didn't have the liability of Trump, would they be doing and polling much more strongly among independents than they are now?
Professor Schiller, Jeff Stein with the article of the weekend on the nation's deficit, again, burgeoning out X number of trillion. Everett Dirksen and I have lost track of the billions and trillions. Is the debt of concern to an academic like you, or is it just the usual debt angst, not understanding the mass, the size, the scale of America?
Well, I think the parties have long abandoned really seriously worrying about the debt. The Republicans and the Democrats, all the Republicans use it. I think solving the debt limit crisis, I think that was, as we saw, something that both parties understood they had to finish and had to get done. But you'll see this rhetoric, Tom, absolutely in the next 4 weeks by the Republican Party. They're going to claim we spend too much money. They're going to want big cuts, and Biden's going to have to hold the line, which may lead to a government shutdown a couple of days after the second Republican Party debate. And that hurts in the end of the day. It hurts Biden in a lot of ways because he's the incumbent, and because the incumbent is supposed to run the government smoothly. If you couple that with another strike, another union strike, if we see the auto worker strike, I think that creates real uncertainty and concern among voters about the Biden administration. So it's a real risk for them.
Wendy Schiller of Brown University. Wendy, thank you for the latest on that Labor Day pitch from the President of the United States, Tom.
It's on unions as well, but buried in the Jeff Stein article in the Post, and there's been other articles on this, is the tax cuts of, I believe, 2017. I mean, maybe, I can't remember the Trump. They're identified as the Trump tax cuts. And there's a point here within the distractions of four legal proceedings and all that, where you're going to get a raging debate into 2024 on sustaining those tax cuts. That's not on the radar yet. It's going to be.
You mentioned the debate on September 27th. Any reason for the former president to show up to that, based on how he's doing in the polls?
It depends on his legal
and the bump
calendar.
that he got in the polls after the last debate.
Maybe
that he
he
didn't
should stay
attend.
away. Maybe it's good.
I think a lot of people feel the same way about that, Bramo.
Well, and this is sort of the question about him. What happens when he starts to campaign a little bit more aggressively rather than just being the de facto front runner? Does he have to? And I keep going back to, given that Wall Street Journal poll that you mentioned with President Biden and the lack of popularity and concerns about his age, what his chances of re-election would be if anyone other than the former President Trump was going against him.
I think that's the man he wants, TK. Overwhelmingly, that's the consensus view that that's the man he wants to face.
Oh, yeah. Absolutely. And I think this weekend, the distraction of the First Lady with COVID, in that I was sort of thunderstruck by the rekindling on a sleepy Labor Day weekend of a president who's 80. This is sort of the weekend where 8-0 came into the zeitgeist.
I think last week as well, after Senator McConnell, Tom, and the events with Senator Feinstein as well.
Absolutely.
All of this kind of building.
Absolutely.
Okay, coming up, Simon French of Penn Gordon. We're going to look at the economy.
Good.
Plenty of economic data from the labour market over the last week, painting a picture of maybe a soft landing and a Fed that doesn't have to hike on September 20th.
We got through the first half hour here. Bramo's like, she's gone for 3 weeks, and she's like, bingo, she's right back in it.
Getting bearish.
Yeah, she's bearish.
Already.
It's a toxic group.
It's fairly tame stuff.
Dusted off the Bramo cam.
Give her a chance, Tom. Fairly tame the first 20 minutes or so. Equity futures on the S&P trying to recover, negative here by 0.1%. From New York, this is Bloomberg. Two weeks of gains on the S&P 500. Let's see if we can make it week 3. Your equity market on the S&P. Equity futures slightly negative by 0.1% on the Nasdaq, down by 0.2. Closing out August, opening up September. August, how tame is this? A monthly loss of 1.77% on the S&P. On the Nasdaq, 1.62%. First monthly loss going back to February, but Tom, really, really tame stuff, considering what that looked like halfway through the month.
Hugely tame summer. I did the sell in May and go away statistic here, and it's real simple. Sell in May, you're up 8% with that August recovery that got that tame August that we had, 20-some% annualized. I mean, sell in May and go away didn't work out this year.
Let's turn to the bond market. 2-year, 10-year, 30-year. 10-year, high of the month, high of the year, 436. All the way back down to the 420s at the moment, 421.82 yield high by 4 basis points. 4 monthly gains, 4 months of gains on a 10-year yield. The 2-year yield last week, though, Tom, 20 basis point move lower on a 2-year, 4.9%. Yields this morning high by 2 or 3 basis points.
And I'm going to look at the real yield, sort of center tendency, or 1.92. We haven't even talked about foreign exchange, which is fascinating this morning, starting with the yen. But the 10-year real yield is what the adults are looking at. And the answer is, yeah, it's midway, but it's really buttressed up near 2%, 1.92% right now. And to have that break through, as Ian Lingen framed out for us last week while Lisa was away, would really be something.
Screaming buy. BMO, 10-year, screaming buy.
10-year, you know, there's some heated... people are placing their bets, John, is what I would say for September. I mean, they're really, it's like sort of like January 1. They're like really setting up.
Let's go.
Mike Wilson, we believe, that kind of thing.
We believe.
Yeah.
That stocks can't rally from here.
Yeah.
Seems to be the belief over at Morgan Stanley. Want to finish in the FX market. Tom mentioned some currencies elsewhere. Let's just finish with the euro. The euro at the moment... trying to hold on to 107.47, negative by about 0.5% here. Jordan Rochester of Nomura raised the possibility of this a couple of weeks ago, threw in the towel on his call for a move of 115, maybe pushing out to 120 through the next 12 months and having a little look at maybe 105 on a euro against the dollar.
To triangulate, the tea leaf here for me, and this is for Christine Lagarde as well, is Euro Swissy. And it's really not like, OMG, Swiss franc strong, SMB's going to intervene. Forget about that. But John, 1, 2, 3, 4 days in a row of ever so slight strong Swiss franc versus euro as an indicator of the European tension.
107.47. Under surveillance this morning, President Joe Biden contrasting policies with former President Donald Trump in a Labor Day pitch to union workers in Pennsylvania. Here's the quote. Lisa, when the last guy was here, he looked at the world from Park Avenue. I look at it from Scranton, Pennsylvania.
What's interesting to me is that Scranton, Pennsylvania was an area that could tilt to former President Trump, and that you saw union membership actually tilt more to the populist rhetoric of the former president. Also interesting to me, how much is Biden hoping that Trump is his counterparty, right? How much is that really sort of the predication of his entire run? What happens if he isn't the front runner? What happens to the Biden presidency?
You know, who's running the shop for Biden? He's not on. Trump isn't on Park Avenue. He's on Fifth Avenue. You know, I mean, he's on Fifth Avenue. I mean, you know, that's identified.
I'm aware.
I take the Bentley down every morning.
There's plenty of quotes from this pitch that didn't really make a lot of sense, Tom. We're turning things around because of you. Elisa mentioned this one. When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. I remember when the former president was going off on his tirade about China and people in Washington were calling him a lunatic. And now we're using the same language. Lisa.
Let's see what sticks. That's all I'm going to say. Let's see what sticks, especially with union members kind of on the fence whether they're going for Republican or Democrat. It used to be just a standby Democratic vote, and that has changed. And how much can President Biden really change that back is really going to be a key question for him.
Let's talk about China, the Chinese economy, with a private survey of China's services sector showing more weakness, expanding at the slowest rate this year in August. The services PMI fell to 51.8 last month, down from 54.1 in July. The hope is that the recent policy initiatives of the past week or so, Lisa, can turn this story around and turn it around pretty quickly.
So I've been reading a lot over the past week about how much the Chinese economy and the slowdown there is going to affect the U.S. and how much it's going to really transmit to Europe. Obviously, the transmission to Europe is much more direct. Brad Setzer over at CFR had a really good commentary on how they could really do this through the currency transmission. That if they let the UN really depreciate, that could really challenge some of the trade mechanism and increase trade to the U.S. much more than the Biden administration would like to see.
We really emphasized that last week, Lisa, and the idea here of yuan right now, renminbi is 7.30, and to see it pop through, and not to get back to 8.22, which is I think where it was in 2005 when they let it go to strengthen out. But the answer is sure, currency is the way to give way there. But their GDP isn't really all that bad. This is a balance sheet issue. This is a crisis of real estate, a crisis of garbage investment. and they got to figure out how to clear that market in an artificial system.
They had a major win
They
last
do okay
week.
there?
That was beautiful.
I was really working on it.
They had a major win last week, Tom, and barely talked about it. Hardly talked about it. Huawei. We've done the teardown. Our reporting here at Bloomberg suggesting that Huawei, along with China's top chip maker, have built a pretty advanced processor to power this thing and basically succeed even with these sanctions from the United States attempting to stop them from doing so.
Now, Bloomberg's been way out front on this off the Asian Pacific Rim Watch. And John, you've been great on this for Bloomberg Television. But the answer is we're more concerned about what the Huawei chip than we are the new chip in the iPhone coming out whenever September Day. 2 of my family's iPhones broke this weekend. It's amazing.
How convenient.
It's amazing how that worked out.
Going into the middle of September.
Two.
But the effort there, Tom, I think is phenomenal. The fact that dropped at the same time that the Commerce Secretary of the United States was visiting the country. All the talk, and we've said this a few times, ignore the talk, look at the action. And look at the action of the Chinese, Tom.
Yes.
To be able to unveil that quietly.
Well, and
it's
quietly,
pretty phenomenal.
This G20 news of China and India, and frankly, America's involved in that as well. I mean,
but Tom, that's a perfect example of the way the West looks at the world. He might not turn up to the G20. Ooh. And at the same time, they're doing something pretty impressive with Huawei last week. That is far, far more important than whether the Chinese leader turns up to the G20. That's just our Western bias to the world, Tom. Who doesn't and who does turn up to the G20 as if that has real significant consequences
I 100% agree.
When they're engineering those kind of changes on the ground in the mainland. I want to finish on this on Europe. ECB chief economist Philip Lane expecting core inflation to slow over the remainder of the year, telling Irish website The Currency inflation is standing at 5.3% overall, which remains high in terms of looking for signals of momentum and signals of directional change. I would underline the fact that there has been some easing in goods inflation and services inflation, which is a welcome development on the next decision for the ECB a couple of weeks away.
Important voice. Matt Bessler was on the couch in Jackson Hole. We were reading the first 3 or 4 paragraphs of the Lagarde speech, which got, a fair amount of play in terms of the speech and being at 60,000 feet. And Matt turns to me and goes, Philip Lane. And so this is an important voice. There's really no American equivalent to Philip Lane in that job that we've seen back to Duisenberg of being the lead economist. And ever more so, John, because Lagarde is not an economist.
And she's a consensus builder.
Yeah.
Clearly, we've seen that as well, Tom, develop. ECB, September 14th, next decision, Tom.
Let's get a brief on that right now and how it folds back into American markets and American economics. Simon French is chief economist at Palmer Gordon with really trenchant essays off the London desk of where we are transatlantic. How far apart is the American and European experiment right now, Simon?
There's big divergence now emerging, probably the largest divergence we've seen since the start of the rate hiking cycle. We've had 175 basis points of hikes from the ECB this calendar year, 100 basis points of hikes from the Fed, so you're immediately looking at a different pathway. But what that does, of course, because of the transmission mechanism, is it means that the ECB are flying into next week's meeting with much less data on what transmission has come through from the policy decisions they've made thus far into the real economy. And I like the fact that you picked up Philip Lane's quote there. The data that came out this morning from the Eurozone, the composite PMI report, slightly undermines that rhetoric, I have to say. It picked up a 3-month high in input cost inflation. And while he's right, on a year-on-year basis, we're still in heavy deflation territory, down 7.6%. Actually, with crude oil picking up, with a bit of an inflection point in core wages in inflation, is that narrative a little bit stale? And therefore, Lagarde's job of as consensus builder becomes really hard going into next Thursday.
Well, the German word for this may be stopping, but I think it means pause. Is pause in the vocabulary of the hawks in Germany or the inflationistas in America?
I think pause is in the vocabulary. I mean, let's not lose sight that, okay, we haven't got consensus for next Thursday, but we still have the market 75% likelihood of a pause, thinking that, we've been here before, haven't we, with the ECB? We have the Germanic-led view, which is more hawkish on inflation, defeated round the table on the basis of data, and I think the latest PMI data, more broadly in terms of output, was pretty broad-based downside misses this morning. And I think that gives the pause rhetoric a stronger hand than it would have had 24 hours ago.
You know, one thing that John was just saying is that Christine Lagarde is a consensus builder, and she's trying to build consensus with a lot of different views on the ECB member governing council. I'm thinking of Isabel Schnabel over the weekend saying that recent developments point to growth prospects being weaker than foreseen in baseline scenarios, but underlying pressures remain stubbornly high, and said that they are being driven by domestic factors, not international ones, meaning it's going to be stickier. How much does she represent the core of the committee that wants to hike rates in favor of the risk of going too far than letting this get entrenched?
Well, I think Schnabel's speech, I read the speech as well, she's one of the, if not the most interesting thinker. But thinking good quality speeches did not necessarily translate through to building a consensus for driving the vote when the ECB Governing Council meet. And while I think she is correct, there is, if you took just the imported inflation component or the producer price component, it's consistent with, on a 12-month view, Eurozone headline inflation being negative. Now, I don't think anybody sees that, and therefore there is a decoupling of the historical relationship, and that goes back to what all the central banks were talking about at Jackson Hole in terms of the data tallying through to their models. But what Isabel Schnabel's talking about actually speaks to the degree to which there may not actually be much spare capacity given the ongoing strength of the Eurozone labour market, which is in complete contrast to the more cyclical activity indicators.
Do you think that that can be sustained? Do you think that there is a recession that is necessary, and a deep recession at that, to really wreck the labour market that you're seeing both in Europe and the US? Or do you think that it's just going to continue regardless because of structural changes?
I personally, I hate the phrase, the idea that an inflation is recession is necessary. I'm a labour market economist. I've seen the impact it has on productivity, on individual outcomes of people losing their jobs, and what that does to the long-term growth prospects of an economy, given all the structural challenges the Eurozone faces. The idea that there will be people around the ECB Governing Council table arguing that we need to have a relatively deep contraction in output in order to squeeze out core inflation. They may have one or two voices. The idea that they're the majority, I think, sits uncomfortably with me.
Are you acknowledging, Simon, that maybe they have a dual mandate they don't officially have?
Interesting.
I think most of the market has interpreted that, haven't they, Jonathan?
I think that's what's intriguing about this moment, Simon, because even the one with the dual mandate, there are questions about whether they would be juicing the inflation story by allowing the labour market to run hot. The trade-offs here, Simon, let's build on that just a little bit and take it over to the Federal Reserve. If that's a single mandate central bank at the ECB, not allowing the labour market to crumble to get inflation back to target, why on earth would the Federal Reserve do anything like it with a dual mandate?
Yeah, and I think one of the reasons why, and bringing it back to the US equity market, one of the reasons why the second half of August was so strong, and we saw that inflection point, I think the 18th of August in global equities, was the idea that the Fed have got the message on that one. They have interpreted fully their dual mandate system, and actually the data is starting to support them. There's a series of data from jolts to payrolls, all suggesting a soft landing, and it's one I'm signed up to.
Interesting. Simon French, great comments as always. Of Panmure Gordon, thank you, sir. From New York City, futures slightly softer. Damien Sasser from Bloomberg on the latest data out of China. Coming up next.
The way I think about China right now is one word, and that word is traction. So when are all these little drips and drabs of policy going to actually, kind of do their thing, get traction, and move the economy forward? The consumer in China is not like hiding under a rock. They have plenty of room to consume. It is a confidence issue.
And they're trying to address that confidence issue. That was Jay Pulaski, principal and founder at TPW Advisory. Live from New York City. Good morning to you. Starting a shortened trading week. Your equity market right now just about negative on the S&P by 0.1% on the S&P 500. Trying to do something and build on the gains of the last couple of weeks, Tom, on the S&P.
That's not the lead line here. Jay Pulaski was on. As a kid, when he was a sophomore, he walked in front of 105,000 people at Michigan playing guard for the Duke Blue Devils. upset. Duke Blue Devils really crushed Clemson. Like John, 28-7.
Are we doing this for Paul Sweeney?
No, we're doing this for everybody. I mean, we're doing this for Jay Pulaski.
Did you watch it?
But it's like, no, I didn't watch. I could give a damn. But I'm sorry, it's impressive. Duke Blue Devils. We're only doing this because Rubenstein's. There's a group at Duke.
He went to Duke as well.
Yeah, it's very Duke.
This is the Duke thing.
Yeah,
just a nod to people who like Duke. What about people who like Michigan?
Michigan?
They're enjoying
Michigan
this moment.
Well,
okay. Shall I complete the market check?
Yeah, do the market check.
Okay, thanks.
Please.
If you could just bring the board back up and we'll check out the bond
let's bring
market.
up the board here.
You were a little bit high this morning by 4 basis points, 421.82. I thought you'd want to talk about Max and Formula One over the weekend.
Yeah, we can do that
10 consecutive
now.
wins, just dominance.
It was fun. I loved it, John, because it's a 101-year-old course. It's flat, like they really struggle going through the turns because of the lateral motion. But the best thing about this, folks, is it's bumpy. Like the cars are bumping around because it's like they're on roads. They're not on some smooth, perfect pavement like Miami.
He makes it look easy, doesn't he?
Oh, does he? He went by the other guy, the guy in the red car.
Carlos Sainz,
Yeah,
red car,
he
the
went
Ferrari.
guy with a red car. and folks, it's like, okay, you're out of the way. See ya.
See you later. Yeah,
You mentioned this before. They ignore the number one guy for the rest
They just
of the
start
race.
focusing on everyone else. The battle between Ferraris.
I loved it. I loved it. I loved the whole thing about
Congratulations to Max and Team Red Bull. Just absolute dominance.
Really, and thank you so much, Christian Horner and the rest, for giving us access to Mr. Verstappen. His incredibly busy day. Thanks for your response here to our. Let me rephrase this. Thank you for your response to John Farrow's smart interview with Max Verstappen. I added about 0 on that. Never adding 0 is Damian Sassar, Chief Emerging Markets Credit Strategist at Bloomberg, and also, of course, NCAA expert. We'll get to that here in a moment. Good morning. Good morning. EM to me is sort of topsy-turvy, and I'm led by the emerging market Japan, where all of a sudden 3% inflation is like, and up goes the yen, weaker Japanese yen, not near 151 intervention. But that's the Pacific Rim tension this morning, isn't it?
Well, I mean, and that's not the only one we have to talk about inflation regarding, right? I mean, we had PPI print this factory deflation actually probably down 3% in China this week. We also get data on trade in China this week. So even though it's a shortened week here in the U.S., there's a lot of data to consume out of China, and no data point more relevant than what's going on in the property sector with Country Garden, who actually made payment on $22.5 million in coupons last week. They made payment on a ringgit bond. They extended a yuan-based note. They have $1 billion of yuan-based debt coming due between now and year end. So they need to, restructure some of that. We'll see if they're successful with it. But, people are looking at other property developers like Agile and Season and Sino Ocean and Vanke and all the debt that's maturing over the next month alone. People are getting a little frightened about it.
Damien, we'd like your opinion on how the policy shifts of the last week change the data in our future. Can you go through some of the big calls that they've made in the last couple of days?
The policy shifts. Are we talking about
around mortgages?
Around mortgages. Okay. So basically, they did extend the down payment on first and second time home buying was lowered to 20% and 30% respectively. And it really doesn't impact much, right? Because most of the cities, the tier 2 and 3, I mean, they're already at those levels. So even Beijing, it doesn't really kind of move the needle so much. And when you talk about a Country Garden, which is predominantly in tier 2 and tier 3 cities across China, it's just not going to move the needle all that much, Jonathan. So I don't think the government's doing anything in the way to help things. We got some PMI data out also, which basically shows the economy going from bad to worse. So there you have it.
So, Damien, here's a question, right? What do they do if you have Xi Jinping, who seems morally opposed to stimulus in any kind of meaningful way, thinks it's welfare, thinks it's the Western way, wants to reject that? Is it basically to go to the currency, allow the yuan to depreciate, and then juice exports no matter to where, regardless of policies, because at the end of the day, price will win?
Well, that's what they've done in the past, right? So, I mean, if that's precedent, I don't believe they're going to do that again. They're not going to do any bazooka big bang stimulus yet, but that is certainly an upside risk to the economy. So when we talk about these trades in emerging markets where people really make their mint, I've mentioned Argentina. I wrote about Venezuela. They have a, bond that basically is backed by Citgo assets that rose 50% year to date. We talk about China high yield and we talk about the China property sector. And I don't want to call it, it begins with an F, it ends with a U, and it's not fondue. But those types of trades, those ones when there's no fundamental justification for owning it, there's no structural reason, maybe there's some behavioral reason for owning it. But, you look at Venezuela, you look at Argentina, you look at Turkey, you look at China high yield in the property sector, and maybe, you have to have a little bit of that on, especially if the rest of the world isn't going into recession, and there might be kind of a risk-on trade to be had there.
So are you basically saying that the risk of China falling into recession, or just the risks that are circulating around China, have been overblown and overtraded? Or are you saying...
No, they're all very justified, Lisa.
Okay,
What I'm saying, though, is
disrupted.
the asset prices, because it doesn't take much to move the needle, as we saw in the first quarter this year. So it doesn't take much to move the needle. Again, no fundamental justification for it, but you just can't ignore it. It shouldn't be zero in your portfolios.
I got to go back to fondue. It's not fondue. That's the tension that's out there right now. Discuss further the fondue of the moment.
Oh, Tom, look, fondue, you're really going to push this one. I mean, look, I got in trouble the last time I was on here because, I was speaking a little bit loosely, freely. Amy slapped me around. So, no, look, seriously, though, I really believe that, China is going from bad to worse. But again, 0% in your portfolios might not be the right positioning. So look, that's all I have to say about it. I'd love to talk about Scuderia. I was really looking forward to Carlos Sainz, really, and it was, he had 14 laps, and then it was bye-bye.
Couldn't hold him back. It's just too quick.
What is DRS?
Drag reduction system.
That's like turbo?
Rear wing opens up.
Yeah.
Less drag.
Do they all have that?
They have that option, and you can use it only at certain parts of the track and only if you are within 1 second.
And some people do it much better than others. Am I right on that?
So the DRS system at Red Bull is much, much better than the DRS system elsewhere, just in terms of the additional speed that you can gain from opening up that little flap in the rear wing, Tom. Okay, was that enough for you?
That was good. I did not watch
great.
it.
It's like bumpy.
Oh,
they're bumping around like
porpoising. We like to call that porpoising, I believe. Is that not? No, porpoising's when the car kind of bumps and
when
it hits.
You're bouncing up, yeah.
Yeah. No, but look, Lewis Hamilton, they need to put him in a proper vehicle.
He needs a Red Bull.
He needs a Red Bull.
I think we all need a Red Bull.
Yeah.
Damien,
he just
thank you.
resigned. I know that.
I wanted to squeeze this in just before you go. This is the question I wanted to ask, and it's not about Formula One. Should we care that the Chinese leader is not going to the G20?
I think you should, yeah.
Why do you think we should?
Well, because you want to have dialogue there. You want to kind of have transparency there. You want to see that, people are kind of looking to play nice, even though the sand pit is a little bit sandy. But I think at the end of the day, it's going to be interesting to see how, the U.S., again, we're moving into a multipolar world, where countries have to pick a side between the U.S. and China. And the question is, those that can maintain that middle ground of neutrality, should they be afforded a premium? I'm thinking India, I'm thinking Brazil.
Interesting. Where does Europe fit in with that?
Well, yeah, they have to pick a side, certainly. And quite frankly, their economies are much more directly tied to that of China. So we'll see which European country. You see what's going on in Italy. So, they're kind of pivoting away from China, which is interesting to see.
Yeah.
College football, Deion Sanders, the Buffs. I was stopped on the street literally. Me and Vetbill were out for a stroll in the 33 degrees Celsius heat. And a Buff stopped me on the street. Explain to our international audience how a stud like Deion becomes a college football coach and stuns Texas Christian University this weekend.
So my microphone fell out of my ear. So Amy, if I go over on this, please just, have somebody smack me around. But the reality is TCU is number 19 in the country. They almost made the top 4 last year. They almost made the college football finals.
They're like a real program.
And Deion Sanders is taking advantage of new NIL laws, the ability that players can move freely and not have to sit out a year. And he's bringing in some of the best talent to Colorado, the Buffaloes. And he brought his son over, who had, I believe, 500 or something all-purpose yards. He was outstanding. And it's all about primetime Deion Sanders, Hall of Fame cornerback, former Dallas Cowboy, San Francisco 49ers.
You couldn't get into the sink afterwards.
Do you want me to say something back?
That's the most famous bar in America.
Okay.
That's where you graduate. You drink Coors 3-2 beer, and one day you don't.
At the sink.
At the sink.
Okay. Damien, thank you.
You used to go to Talagi's, but that's shut down, so you go to the sink.
Are there any bars at these colleges that you haven't had a drink at?
No, although Ohio State is really difficult because you go down the road there, and there's like 14 bars in a row. You don't even know which one to go in.
You've done that too?
I've done that too.
Me
and Rachel.
I really believe you, but I believe you there.
She led the way. She knows the bars.
Katie Kaminsky, up next.
This economy has outperformed this year, both in terms of growth and bringing inflation down.
Inflation is going to come down faster, and that would allow the Fed to cut in 2024.
They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate.
The labor markets are normalizing.
I think it'd be really unlikely that they're going to move at the next meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is not the September people forecasted about 9 months ago. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 trying to recover, down by almost 0.1% on the S&P right now. TK, things are better, far, far better than we thought they would be 9 months ago.
Yeah, some would call this New Year's for the business community here, back from the summer, kids back to school today, tomorrow, the next day, whatever. I mean, it's sort of like an important moment forward. And as you say, they didn't get September 9 months ago. I didn't think they got September or August 5 weeks ago. It has been a topsy-turvy end of summer. Why should September be any different?
At Goldman Sachs, recession, 15%.
Yeah.
Can we get the quote up from Jan Hatzius? Reads as follows. First, real disposable income looks set to re-accelerate in 2024. Goes on to say on the back of continued solid job growth and rising real wages. Second, we strongly disagree. Lisa, I know you've got a view on this one, with the notion that a growing drag from the long and variable lags of monetary policy will push the economy towards recession.
That was the exact same quote that I had highlighted when I read this. And the part of the reason why is because he's basically pushing back against everyone who says that we will see a natural slowdown in growth, which raises two questions. Number one, how bullish do people need to get? You've got Goldman Sachs coming out and saying that tech needs to also rally, that AI is not underpriced, et cetera, all around bullish. And number two, does the Fed have to do more to curtail some of the growth and the strength and, frankly, the ongoing and the stickiness in inflation?
Heart of the matter, Bloomberg Financial Conditions Index still very accommodative, a positive 0.36, nowhere near the negative restrictive number Chairman Powell needs. But, you know, I just going to say here, the bulls aren't getting enough love, and they did not get enough love over the long weekends. Nobody's talking about Stolfus. Nobody's talking about Bikram Chadha. Nobody's talking about Yardeni, Ankampora. Sell in May and go away. Bring it up on radio. I got the numbers here for TV. Let's give it out to radio across the state. Sell in May, John. May 1st. SPX up 8%, annualized up 26%. That worked out.
Year to date, double-digit gains.
Yeah.
I think the Bulls have had some love this year, Tom, don't you?
I think the modern internet digital media has a gloom bias.
That I agree with. Of course, the clickbait on the perma-bear side of things.
It's just
I
there
totally understand.
on Fridays. It's
Totally
usually
understand.
out of control.
Can I just say anecdotally, the pushback to the perma-bears has been increasing and incredibly... No, but it's interesting. There are many people saying you got it wrong just to concede, and a lot of the bears aren't conceding, even though they're coming under a lot of heat. I will say that they're not getting love.
Just anecdotally.
Anecdotally.
Of course. Okay.
Anecdotally.
Futures on the S&P.
Did you
look
dust
like
off
this.
the lens to the Bramwell cam?
She's ready to go.
Obviously.
1 week's rest. Futures on the S&P, negative here by 0.2%. 2 weeks of gains on the S&P 500. Best weekly gain going back to the middle of June for both the S&P and the Nasdaq. In the bond market, yields lower at the front end through last week, aggressively lower on a 10-year right now. Yields a little bit higher by 4 basis points. Lisa, your 10-year, 422.42.
It's a quiet week to start the new year in terms of just post-Labor Day work week. Wednesday really is going to be key. We get the Fed's Beige Book. I am very interested to see the influence of Barbie and Oppenheimer and Beyonce and Taylor Swift, which I think a lot of people are also looking at. Not joking. We also get ISM services data at 10 a.m. for the month of August. And do we have a similar kind of feel that we saw in Europe overnight in the sense that, you know, there is this cooling that could even cool into sub-50 reads? Throughout the week, who isn't speaking from a central bank across the world? ECB's Christine Lagarde, Bank of England's Andrew Bailey, and John Williams of the New York Fed are the ones that I'm watching. How much they guide towards some sort of balance of risks in terms of weighing both the potential damage to the labor market versus really curtailing inflation. And Thursday, we are focused on all of the union activity. And John, I feel like we have to really keep focusing on what this could mean longer term. There are unions at 2 of Chevron's LNG export plants in Australia that have threatened to stop working on Thursday if they don't get certain concessions. Unclear what this means for European natural gas in the short term. In the long run, there is some risk there. But this just is one of many of the same kinds of anecdotes of increasing union activity, whether it's the UAW or whether it's in Australia. Got to keep an eye on it.
We'll catch up with AMH on some of that union action stateside in about 10 minutes. Just a word on the Beige Book. Patrick Harker of the Philadelphia Fed sat down with us in Jackson Hole, talked about things anecdotally, Tom. just some examples of what he's hearing in his district, in his region. I think this is really, really important. The Beige Book finally, and I asked him the question directly, you telling me that maybe the Beige Book from the Federal Reserve might be more important than some of the hard data. The Dallas Fed manufacturing, if you look at some of the commentary there, Tom, from businesses, ain't good. Not pretty. I wonder how much of that shows up later this week.
And it matters in Philadelphia. You got two things going on. The character of the small business. I don't mean like 12 employees. I mean like 1,200 employees. The character of small business within the Philadelphia Fed. And also Harker not only is a Wharton guy, but somebody really steeped in the business pulse. That makes for an important comment from him.
It's my best effort at sounding the Beige Book at 2 p.m.
That was
Eastern
very
time.
good.
Thanks.
It made it very interesting.
Thanks a lot. Katie Kaminsky, Chief Research Strategist at Alpha Simplex, joins us now. Katie, short question just to open up. Are you still short the Treasury market?
Yes.
436 didn't get it done for
Come
you.
on. First time guest.
Hey, it
you
was
got
a
to go
short
longer,
question.
Katie.
No. There is a follow-up. It's okay.
Please,
we
follow
welcome short answers. Katie, let's elaborate on that. We saw 436 on a 10-year. We got back to 5.1% on a 2-year. What exactly are you looking for? Why is the juice worth the squeeze?
Well, I love that you asked this because everyone keeps saying, let's be bullish, the bond market, but look at the price. Look at the price all summer. It has continued to go up in yield. So yields, even though they pulled back last week, they continued on Friday and they're continuing today. And what we're seeing is we need to see a flatter yield curve. And everyone's really ready for there to be a pause. And there's probably a pause, but I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down. Thus, we're going to see higher yields for a little bit longer.
What does it mean to be bearish at a time where yields are jumping all over the place? Are you outright short or are you just not buying the stuff?
So in the futures markets, the technical signals have been outright short for 2 years. And that sounds interesting, but it really means that they're, in some sense, in contrast to what you would think about most fundamental traders have been thinking about the bond market. But we've started to see a lot of fundamental traders as well saying that they're also short the bond market, which means that they're shorting bonds, expecting that we're going to need to see a flatter yield curve, that we're going to need to see a higher yield return on longer term debt. And this makes sense because maybe we need a duration premium back in the curve for the short term.
When people ask you for some sort of fundamental explanation for why longer-term bond yields will remain high, pointing to the idea that we're probably going to go back to some sort of normal that we saw pre-pandemic of slow growth and slow inflation, what do you say? Is it just technical? Is it foreign buying? Is it something about just the debt load of this nation?
That's a really good question. I mean, I think it's a combination of either a preference for holding that long-term debt, either as a hedge for potential deterioration in financial conditions, a view that we could have rate cuts faster than they might occur, is the two common ones I'm thinking about. So a lot of people are thinking, well, hey, things look good, the Fed's going to come in and cut. But my concern is that they think that, but now it's looking like it was originally going to be 2023. Now they're saying 2024. Who knows when it's going to be 2025? My view is that we're going to take time to get to that point with the Fed, and thus interest rates have to stay higher for longer. And if you're going to hold a long-term bond, you need to have that duration premium over the shorter-term return of holding shorter-term debt. So in that sense, it's a fundamental view in that sense.
Katie, that might be an argument for why yields should stay high. What's the argument for why they will be higher?
So why they will be higher is that I think that it's not priced in that it could take longer to get to cuts. And so people are assuming that, things are going to go back to normal and thus shorter term rates will go down and we'll have a healthier curve. But if in fact they have to stay higher for longer in the short end, that means that longer term rates have to go up. And it's a simple question when people start to realize, wait a minute, I'm getting 5-something% for 2 years. If I'm going to hold something for 10, maybe I want a little bit more.
Catherine, let's talk trending. Let's talk Katie on the great giant Wells Wilder. If I look at Brent crude, I have a nascent uptrend like I had 3-4 years ago as well. On ADX DMI, on parabolic SAR, on exponential climb and moving averages, is Brent crude trending higher?
Yes. And that's the biggest thing we've been focusing on. So if we want to connect this inflation story, the thing we're watching is the oil market, because we're looking for catalysts, something that might give us another wave of uptick for upside risk in the inflation numbers. Those are the things that are going to cause the Fed to be more cautious. And also, we're seeing signs of that outside the U.S. Of course, we saw some. Yeah, exactly.
Katie, come on. It's the beginning of the year, the beginning of the business year. What's your point figure target on Brent crude right now? Over 100?
I don't have the exact number in my head, but we're definitely seeing that's one of the biggest growing trends in terms of our signals. The signal strength for Brent crude has been one that's been ticking up lately. It did revert a little bit in August based on some data on China and other, the dollar also weakening a little bit. So we started to see some dollar strength, dollar weakening messing with some of that trend. But in general, that has been the trend to watch more recently. And the reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
Katie, thank you for the update. Katie Kaminsky there. Alpha Simplex on a bond market and a crude at the end there as well.
Didn't give a price.
5-day rally on Brent coming into today. A bit softer this morning, 88.35 on Brent crude. Does it matter if it's a demand side rally or a rally led by the supply side, Tom? Because arguably over the last week, this has been a story about tighter exports and output coming from Russia and potentially from Saudi down the road.
I'll let the oil pros answer that, including Will Kennedy and our great team at Bloomberg. But the answer to me is on the supply and demand nexus, if you get it post-pandemic, it's just another indication that we're beyond COVID.
Are we beyond COVID? I hope we're beyond COVID.
Well, if oil pops out on a better Pacific Rim demand, that's what you get.
Wear a mask. I was going to wear a mask for the set. Don't wind me up. See what would happen. Okay. If you're just tuning in, welcome to the programme. The S&P 500 negative here by 0.2%. Is that where things are going, Bramo, later this year?
I think there's enough pushback that maybe not.
Go on, you want to be super bearish?
Yeah, well, no, I don't think that's the case.
Isn't it?
Hold on a second. No, that's not that we think that it's going to stop the world. But sure, people are getting sick from COVID again. And we're not just talking about Joe Biden's wife. I mean, I have friends.
The First Lady, Lisa.
Yeah, okay. It's the First Lady. It's not just the First Lady. Seriously? What is this? But it's also, I've got friends and relatives. Everyone's getting COVID
I decided this weekend when the booster comes
Biden's wife sounds like the lady down the road, around the corner.
Isn't that what he wants? Carry on.
I decided this weekend, John, when the booster comes out, I will get it. I hope it's the Pfizer booster, which is what I took before. But I predict there will be a massive political and cultural debate over boosters. And I'm going to listen to the pros like we talked to at Johns Hopkins.
Okay. We'll get Johns Hopkins back on. We'll catch up with them about this,
What, every day?
No, not every day. I don't want to go back to that. Not every day.
It's not like
doing
that
every day.
It's not like that.
Because we've been exposed to it, so you're not going to have the same kind of mass hospitalizations. That would be terrible, and nobody wants
I think there's a lot of bad science going on right now. I take real issue with it.
What's the bad science you don't
The
like?
bad science here is not understanding the purpose and outcome of boosters and vaccines. They protect you if you get it as the First Lady.
Okay.
Thank you.
That's enough. That's enough COVID for this week.
Look what Bramo does to us.
You're going to blame me for this?
I know.
Kaylee's all sunshine and flowers. We are the world.
Bramo's all masks and COVID.
Yeah, all gonna die.
Aren't you glad that I came back?
Yeah, we're
so glad.
I can tell.
Winnie Caesar.
We were gone for 3
Such
weeks.
joy.
Coming up a little bit later. AMH up next in DC.
When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. When the last guy was here, your pensions were at risk. We helped save millions of pensions with your help. When the last guy was here, he looked at the world from Park Avenue. I look at it from Scranton, Pennsylvania. Wall Street didn't build America. The middle class built America, and unions built the middle class.
President Biden at a Labor Day rally over in Philadelphia over the weekend, Tom, making the point that he's your man for the unions going into the election next year.
That is core Joe Biden. That is a religion from a long time ago, John. I'm not sure how it plays today.
After decades in Washington, I'm still the man from Scranton, Pennsylvania.
Wheelhouse Joe Biden, comfort level off the chart. And I just wonder, I thought that Professor Schiller from Brown was brilliant on 7% unionized in America. That doesn't get you elected.
That's why you get the best of both worlds, Tom. You get to say, I'm a union guy. And at the same time, unions don't cause you many problems because union membership is so low.
Yeah, I think that, but there's a trend. I mean,
all of that stuff.
You know, I think, John, you helping out here, in that it sort of crept up on us through this summer, and all of a sudden it's there. And, you know, Liam Denning, writing for Bloomberg today, is just scathing about the moment we're in coming up in 1 week.
What did he say about the unions, about UAW?
Well, this is really
Detroit
important,
3.
and it gets us into Anne-Marie here. He calls it pricing, payrolls, and payback. The payback is the political part of it.
Oh, the payback feature of it, yeah.
Same with UPS, the Teamsters.
This is a decade in their minds, arguing, Lisa, that they've been underpaid for the best part of a decade, and we've reflected on this a million times in this programme. Everybody has had those annual evaluations over pay and have been told, not this year, inflation's too low. And now this is this moment for some of these unions to say, well, the time's right now.
And I would argue they're getting the wage increases. They're not striking. And President Biden, I would argue, is getting a pass because he can have pro-union rhetoric without the strikes to accompany it that do shut down business and do potentially gunk up some of the infrastructure and the supply chains.
If you had union membership now in line with the membership we had back in the 70s,
be totally
the pass-through from inflation into wages would have been brutally high. And we've had a very, very different situation. So the soft landing that the president is hoping for into 2024 arguably would never have materialised if we had the kind of union membership, Tom, we had back in the 70s.
Yeah, I'll go with that. And I'll go with the disparity of UAW between traditional UAW workers and the whole burgeoning EV market. They're trying to set up a two-tier labor structure. That sounds familiar with the airlines of years ago. And, you know, that's where we end up, is this being a major theme. When did you say, John, September 27 is the next presidential
Yeah, that's
debate?
the debate. That's the
It's
debate
gotta
for the
be.
Republicans.
Can you imagine that debate with UAW on strike? Whole different debate, to say the least. Briefing us this morning, Anne-Marie Horton, Bloomberg UAW correspondent, joining from Washington, is, well, you brought to me Liam Denning's wonderful column. I'll get it out on Twitter, folks. And he talks about pricing, payrolls, and payback. Payback, Anne-Marie, is your territory. Who's paying back whom?
Well, workers really feel like they have leverage at this moment. They also feel like they have been left behind. They were there taking pay cuts when there was, of course, the potential shutdowns of all these big auto companies and the bailout. They wanted to make sure that those auto companies were going to remain in America and that they could continue working there. So they took pay cuts. You also had, over the course of the COVID pandemic, a lot of people in the private sector being able to work from home. And then you had this quiet quitting, everyone feeling like they could go out and extract more from big companies in terms of pay and leverage on how they want to have also work-life balance. And now what you see for these workers, that they feel like for years they have not gotten a fair deal. They also feel like they were there during the tough times of the pandemic. So they are not just asking for a more than 40% pay increase. They also want a much less working week. So that's what you see right now when it comes to payback. It was interesting to hear the president speak yesterday, though, when he was asked by reporters on the sidelines if he thought there would be a strike, and he said he didn't think so. And Sean Fain, the UAW president, came out and said, well, he must have different information than I have, unless these companies plan on
what's he supposed to
the
say?
night before.
Yes, there'll be a strike. You know.
Well, no, and their intent is not. Well, he could say that he's concerned. You know, there is consternation in the West Wing about a potential strike.
Okay,
so
but
that's what the fact is.
Let's conflate two stories here in Washington this morning. We're off the record, the Hay Adams Bar, you know, your corner of the bar where you hold court about 5:30, 4 days a week. You and I roll out of the off the record, and right up the street is the UAW headquarters. Meanwhile, Joe Manchin is really threatened in re-election. How does someone like Joe Manchin or Sinema, I believe an independent of Arizona, or even Bernie Sanders up in Vermont in re-election, how do they deal with the burgeoning union movement?
Well, I think you have to go back to John's point. yes, there is potential that we are going to see a strike from UAW. There's also potential that there could be a strike from the American Airlines flight attendants. We still have on strike the writers union, but it is not impacting the overall economy just yet. So right now, I think it is way too soon. What those senators you just mentioned, what is front and mind for them is that they are back today, is that they need to figure out how they're going to keep the government open past September 30th. For the White House, this is a huge issue because the president continues to want to have events like he had yesterday, saying that he is the most pro-labor union president in modern history.
So going forward, we're going to talk more about this deadline, the potential for a government shutdown. But on a broader level, when it comes to the whole union push by Biden, there is an issue, an angst in the Democratic Party that they have lost the Rust Belt. They have lost the working class voter. How much are they winning it back with this type of rhetoric and argument?
Well, it's difficult because this administration is also pushing forward a climate industrial policy. And that's what Liam Denning's piece gets to today. And he said it's more about the political will and economic will of this industrial policy. It's not just climate change provisions. This is the biggest industrial policy we've seen from the U.S. government since the end of World War II. And at the heart of that is electrifying the grid. Well, where these plants are opening up to do that is in the South, which historically has not been a pro-labor union sector of the economy. It just isn't. And this is why you see a lot of companies actually making sure some of these plants are in the South, like Tennessee. And you've seen the UAW workers have a pretty strong reaction to the U.S. government when they were giving a lot of subsidies and loans and grants to these companies that were opening up factories in the South. Just last week, it didn't make a lot of headlines, but the Energy Department came out actually with $12 billion to retool current facilities. So that would be in Detroit, in the Rust Belt, to make sure that they are also ready for electrification. So I think you'll see more items like that from this administration if they want to make sure they are shoring up these individuals in the Rust Belt.
AMH, let's finish on this poll out of the Wall Street Journal. Plenty of numbers in there. Let me pick out a couple. 73% of voters said they feel Biden is too old for a second term. Here's another number for you. 2/3 of Democrats said Biden was too old to run again. 2/3 of Democrats. Anne-Marie, how does he respond to that?
Well, the president responded to it yesterday saying, yes, some people say I'm old, but I come with wisdom. He's trying to use it to say I'm very wise, and something the president always likes to talk about as well is that people doubt him and then he's able to succeed. I mean, that's really the story as well of President Joe Biden over the course of his entire life. But especially in his political course. I mean, many people didn't even think he was going to be the nominee to be the Democratic to represent the Democratic Party. But Jonathan, whether it's this Wall Street Journal poll or the AP poll, this is becoming an issue for the administration because it's not just independents, which they're worried about, it's within their own party. But still, Democrats will maintain that regardless, they still will vote for Biden if they're the ones, if he's the one that the Democratic Party in the end, and it's likely to put forward as the sole nominee for the primaries. So I expect more of this. It's a big issue on the Congress as well.
It's not going away anytime soon. Anne-Marie, thank you. AMH on the latest down in Washington, D.C. Coming up, the latest on the pricing around the ARM IPO. We'll bring you some numbers and we'll talk credit with Winnie Caesar of Credit Sites. Live from New York City. Good morning. Live from New York City this morning. Good morning. Your equity market shaping up as follows on the S&P 500. Negative 0.2% on the S&P. No drama here on the Nasdaq, down about 0.4. Pulling back on the Russell, the small caps. Much more negative. We're down here by 0.8% following a month of losses on the S&P. But pretty tame stuff that we've discussed, Tom, this morning so far. Losses on the S&P for the month of August of 1.77% on the Nasdaq, just down 1.62.
I'm going to push against the drama. You mentioned it earlier, John. I think you're right. Euro threatening a 106. I think foreign exchange is talking to us within the quiet of a Tuesday as the business season
Would you like
starts.
me to skip the bond market and get straight to the euro?
No,
and
I just
exchange?
think the no drama in the bond market is there. Look at the real yield. I just got the print. The 10-year real yield is a 5 basis point jump to 1.97%. There's some drama going on out there away from, a quiescent bond market.
We'll get away from the stock market. We'll turn to bonds briefly. 2-year, 10-year, 30-year. The drama of the last couple of weeks, 436 on a 10-year, back down to 422. Yields popping a little bit this morning by 4 basis points. The 2-year having a look at 5.1% in the last couple of weeks, and now back down to about 492. Yields up at the front end there by 4 basis points. And dollar strength the story in foreign exchange. The euro against the dollar. Tom with one eye on that. The euro at the moment, 107.34. Negative by 0.6%. Going into the ECB on September 14th. That's a couple of Thursdays away, Tom.
Sterling 125.51, round it down. Maybe it gets to a 124. That's a different price point.
Yeah. By definition, yeah. Yeah, if price changes, it's a different price. Under surveillance this morning. Goldman Sachs cutting the chances of a US recession to 15% from 20. You're killing me. Chief economist Jan Hatzius, writing quote, Friday. We still strongly disagree. You're so upset about Friday still. Let's get to Jan Hatzius. Let me start that quote again.
Please.
We still strongly disagree with the notion that a growing drag from the long and variable lags of monetary policy will push the economy towards recession. Your second story from Chinese developer Country Garden avoiding default, at least for now. The firm made good on 2 bonds within the grace period, but the debt crisis isn't over. Country Garden bonds are trading between 9 and 14 cents on the dollar, while the Chinese government looks to boost the property market by relaxing mortgage rules. TK, have they done enough? And is there more to come on the policy side?
And I'm glad you brought this up, John, because this is about the property market. It's about domestic affairs. It's about the balance sheet of cities, the SOEs, the state-owned enterprises, and the rest of it. I'm still seeing with the FT, with a great article this weekend, China growth of, to be kind, 4-ish to 5-ish. That's not like doom and gloom, but that's not what this is about. This is about their domestic balance sheet, which is a train wreck.
Well, you've got to compare it to where we thought we would be starting the year, Tom. We thought maybe closer to 6 on GDP, and certainly not a 4 handle. I want to finish on this story. SoftBank's ARM planning to raise as much as $4.87 billion in what would be the biggest IPO of the year. The lower than the range, Tom, lower than estimated, $8 to $10 billion they were looking to raise, Tom. So 4.87, they were looking to raise 8 to 10. Lisa, just in terms of valuation, they were looking for something in the 60s, maybe close to 70. That IPO looking to raise maybe something closer to 50 billion plus. So we've cut this one big time, haven't we?
$64 billion was the valuation of ARM back with the Vision Fund earlier this year. And now we're looking at 50 to 54 billion based on the price range. So a couple questions here. SoftBank, they're retaining a bigger slice than they previously thought. Are they trying to minimize losses basically at some point? That's number one. And number two, does this speak to the appetite, given that it is going to be the biggest IPO on the NASDAQ going back to Rivian? How much does this speak to something more general versus a specific story?
Broader market problem or a SoftBank valuation problem?
Exactly.
I've seen a lot of SoftBank valuation problems, haven't we?
That's been a perpetual theme, hasn't it?
Can't get away from it. This was meant to be a win, Tom. And over the last week, looking less of a win.
You know, you look at the eight paragraph summary here. ARM announces launch of IPO roadshow. Mizuho Securities USA is the title's hilarious. They're the roadshow manager or something. What are they going to do? They're going to do rubber chicken at the Hilton Hotel with 45 days baloney. They're going to call up 5 people and say, we have Apple as a minority interest. What price will you take? Because we've screwed up so bad the last X number of years. I think that's going to be the real conversation.
The reviews of the food on the roadshow. Give us more. Rubber chicken, what else?
Well, no, the problem with road shows, besides now it's all merchant swag and all that garbage, it's like you're going to the Oscars or something.
Just zoom it.
Is if you do it 3 or 4 times a week. That's the issue. It's not like a road. In the old days, there were enough IPOs per week where it was rubber chicken 4 days a week, which is, after the Tuesday.
Is that how young Keene ate back in the day?
Well, people don't realize this. I mean, there's a prospectus here. It's all digital. Rain Securities is the financial advisor of the Barclays involved, J.P. Morgan. Mizuho is acting as joint book running managers. And Mizuho, I think, is in charge of the tablecloths at the roadshow. The bottom line here is, in the old days, you had a red herring. You actually read it. Some guys read it with highlighters where they could look at the cash flow, it's called securities analysis. I'm not sure what it is with ARM.
You're suggesting there is no security analysis?
I'm not suggesting that. I'm suggesting this is a challenged IPO already. I'm probably going to... Marcus Ashworth is brilliant on this.
No, he has been good, Tom, and I'm with you. Based on what they're looking to raise, it's half what we thought they'd look.
What do you think a roadshow?
And looking at the valuation,
the
it's much
roadshow
lower
in London's the Dorchester Hotel with an umbrella and the drink.
It's meant to be the Dorchester.
Yeah, that's what they have. The roadshow. They put an umbrella in the drink.
I've not had one of those.
It's part of going to London.
Okay. All right. We've got a good guest, Tom, if you want to get to her.
Winnie Caesar here, and this is an important conversation for global Wall Street, particularly the linkage between debt, bonds, and stocks. Winnie Caesar joins with CreditSights this morning. Winnie, just cut to the chase. What is the spread market telling you right now in a given category of debt? What is the difference between great debt and bad debt telling you?
Well, the difference between great debt and bad debt is telling you that things are looking better than they did 12 months ago, for sure. We've seen a pretty nice recovery in the lowest rated parts of the market, the junkiest parts of the market, but it's still not, screaming things are super overheated, super rich, spreads really, really tight. And we are actually seeing that higher quality spreads are still a little bit wide just because duration has had such a challenged 18 months now at this point.
What is the linkage between your world at CreditSights and guessing the equity market? Can you take spread analysis and bring it over to an equity call?
So it's a little bit tricky to bring it over to a full equity call. What we can say is that credit, especially investment grade on a yield basis, looks far more compelling than it has really for the past 20 years relative to equities in terms of S&P 500 yields. And that's one of the reasons that we've remained pretty constructive on credit. We're in kind of a neutral carry-oriented position right now in both investment grade and high yield, because the relative value compared to equities feels like you have some pretty good downside protection in fixed income and corporate credit, but you also get really good carry and yield and income generation right now.
That's the buyer side. I want to talk about the seller side. This question of investment grade and high yield bond issuers who are lining up typically a very busy month in September. Torsten Slok of Apollo was pointing that out, expecting it to be the same this year. I just want to start with a very simple question. Why would any high yield company sell debt with an 8.4% coupon at a time where they were used to something that was free? They're looking at an economy with a lot of question marks around it, and they don't need to.
Well, I think that for the high yield market especially, we've seen a bit of an issuer strike for the past 12 plus months because, to your point, they didn't really need to do anything. Maturity schedules had been really pushed out. There's not been a lot of M&A, not a lot of LBOs, not a lot of reasons to come to the market. At this point, though, investors are starting to get a little bit concerned. And so it's almost as if it's a show me story. And so we have a lot of companies saying this might not be the most attractive financing that we're ever going to get. But we haven't seen valuations and all-in borrowing costs come down all that much over the past 12 months. So we should perhaps just raise some new capital, demonstrate to the market that there is receptivity to our company and to our business operations. And then in 2 or 3 years, given that high yield bonds are usually callable, we might be able to refinance at a much more attractive level.
Is it the same story for investment grade companies? I'm looking at a 5.7% rate. Again, significantly higher where it used to be, but less so than in the high yield market. Are you getting this sort of sense that maybe this is where yields are going to be? That corporate financial officers are saying, you know what, this is the new normal and we have to adjust to it?
I think that that is definitely happening to an extent. And I think that there's a little bit of a fear in this higher for longer type environment that yields go even higher and all-in borrowing costs go even higher. And so sometimes we're seeing a little bit of front loading of issuance ahead of potential Fed meetings with more rate hikes or more moves upward in the long end of the U.S. Treasury curve. And also the investment grade market just always has a lot of maturities that need to be rolled over. You have a high concentration of banks, which have a lot of regulatory capital reasons to be tapping the new issue market. And so investment grade, they don't have as much of the luxury of waiting as opposed to the high yield market, where you do see those maturity profiles that tend to get a bit more pushed out.
Well, speaking of roadshows and rubber chicken, we were just talking about the ARM IPO. Are bond deals getting done? I mean, are they getting done as they usually are with 5 phone calls and no rubber chicken?
It really depends on the credit at this point. We're seeing some issuers come to the market priced with very little new issue concessions, so not a lot of a discount to existing bonds. And then you're seeing some issuers come to the market and, they could have just chosen the wrong day where the markets are a little bit more volatile. Perhaps there were some negative headlines around China and more macro front. And you're seeing them get punished a little bit with much steeper new issue concessions. But for the most part, deals are getting done. We're not seeing a lot of deals, coming to market and then getting pulled, which is a very encouraging sign and also just indicative of the amount of cash that is still on the sidelines that needs to be put to work in something.
Willie, just quickly, supply this week. Have we got a lot?
I think that we will absolutely have a lot of new issue supply this week. September, seasonally, very strong month, and we do have the Fed and CPI, a few other headline things kind of mid-month. So I think issuers will definitely be looking to get ahead of those events.
Interesting. Might explain the move we're seeing in the Treasury market this morning. Winnie, thank you. Winnie Seater there of Credit Sites. Often when you anticipate a big slate of supply, Tom, kicks around the Treasury market just a little bit.
It does, and I don't. It's been so long, John, since we had a normal yield environment. I can't remember what CFOs do when yields are solid. There's a real yield out there involved. My answer is they're going to do business as usual, and as she mentioned, there'll be the haves and the have-nots within the bond space. But it's not like there's going to be a panic. OMG, I'm not going to do anything.
No, market's not shut, Tom. It's just more expensive.
Yeah,
that's the change.
Oh, I like the phrase "more expensive" a lot. I think we underplay that.
Yeah. If you're just tuning in, welcome to the programme. Your equity market looks like this on the S&P 500. Slightly negative through much of this morning. We're down here by 0.1%. Coming up a little bit later, one of the best, one of our favourites, Neil Dutta of Renaissance Macro. For all the doom and gloom out there, the forecast of recession,
Absolutely.
Neil Dutta pushing back aggressively through the whole of this year. And Neil, that smile that he's wearing there, TK, I have no doubt he'll be wearing it at about 8:30 Eastern Time.
He wrote 2 paragraphs umpteen months ago and saying it's this simple. Wage growth will be what it will be, and as inflation comes down, the vector is towards increasing inflation-adjusted wages.
Real incomes get better.
He was pretty lonely on that.
Well, I can tell you, Jan Hatzius is basically saying the same thing over at Goldman.
And it was strong language. To your point,
Sure.
You put up the quote on radio, and I believe I'm quoting correctly, strongly disagree with the recession call out there. That's strong language for Jan Hatzius.
15%. I'm always intrigued by these
What is
percentages.
that?
Where do they
Yeah,
come
where
from?
does
What
that
does
come
it go?
from?
15%. Just tell them 15%.
I don't.
Be nice to catch up with Jan, wouldn't it? It's been too long.
Yeah. Well,
Cool. Well, we'll try and make that happen
Try
one
to-
day.
and Peter Oppenheimer, too, with an important note off the London desk.
I saw
this
that
morning.
too, yeah. Be nice to catch up with Peter too.
Nice to catch up with him, too.
Alex Webb on the Huawei teardown coming up a little bit later. This is really important stuff. So we get this new Huawei phone, Tom, and we're wondering, well, how is this being powered? Where are these chips coming from? Who's powering it? And then we work out that maybe this has been done on the mainland
So are we
in China.
saying
This is a
that
huge
there's
development.
a secret thing in the chips that can monitor us? I don't think that's the allegation, is it?
No, we're saying that there's been tons of sanctions to slow down the development of things like
And
this,
they're developing.
potentially.
And they're developing.
they're
Sanctions haven't worked.
doing it. Sanctions have failed, and I'd go one step further. They released it when the Commerce Secretary was in the United States, Tom, had
In
left
China.
the US
Yeah.
and was in China. That to me is just
Yeah.
an amazing turn of events. Futures right now slightly negative from New York. This is Bloomberg.
In China, they have their structural problems. After 30, 40 years of an economic wonder, they're reaching also, I guess, a level of maturity where you're dealing with structural issues as well. So I think we have to take a little bit of a cautious stance on that and see how things develop and not expect rapid growth as far as the economy is concerned in the short term.
Ola Kalanius there, the Mercedes-Benz Group CEO, speaking at the International Motor Show in Munich over the weekend, catching up with Bloomberg's Ollie Crook. TK, talking about a weaker Chinese economy, what about the stronger Chinese competition domestically for some of the automakers over in Germany?
Yeah, I'm going to step away here from the technology. It's a 7-nanometer processor. Vlad Savov and Debbie Wu showing they're smarter than I am. And, I learned a long time ago, listen to the pros on chips, and I get the feeling that pros have sort of been surprised by this.
I was talking about cars, but you want to talk about Huawei?
I would
I'm
talk
guessing
about
right now.
Huawei.
Okay,
And
great.
I think
Well, let's
that's the
do that.
technology lead.
Sure. I agree. The top chip maker in Huawei, top chip maker in China, Tom. coming up together with a fancy processor. What's the phone called? The Huawei's Mate 60 Pro.
Yeah,
you think Apple should be worried about that?
I don't know if they should be, and Alex will tell us this. But John, you've been leading on this, and you're right in that. We're not supposed to give them technology, but why do we worry if we give them technology if they already have the technology?
Alex Webb joins us now to discuss of Bloomberg Quick Take. Alex, are they getting that done themselves?
Well, that's the real news here as it's evolved over the past few days. I was talking with you about it a few days ago, just before the weekend, and we were asking, well, is this just chips that they have left over from TSMC from before the sort of sanctions kicked in? This teardown that our colleagues had done on their behalf shows that it is a chip made by SMIC, which is essentially China's homegrown competitor to TSMC. TSMC, which is the maker of chips under contract for any number of people from Apple to NVIDIA and beyond. Well, SMIC makes chips for other people's designs in China, and the teardown shows that this chip made in the 7-nanometer process is made domestically in China.
This is quite a statement, and we can talk about different dimensions across national security, geopolitics, the relationship between the US and China and sanctions. Alex, can we just focus just briefly on Apple and the competition they might get for the new iPhone that's unveiled potentially in a week or so?
Yeah, it certainly feels like it's a little bit of competition for Apple. The key question is, have they been able to make these chips at scale, right? That is what TSMC can do. A lot of people are very skeptical about whether SMIC can do that. And if they can't, well, then the next iPhone, which will be unveiled shortly, is unlikely to have significant competition. Nonetheless, sales in China have been slowing for Apple, partly as there's broader competition. The final thought, of course, is that if Apple unveils a new chip, which is made on the 3-nanometer process, that is quite a lot further ahead than what's happening in China right now.
Okay, I get that, but that's the heart of the matter, and it's a brilliant. The Bloomberg story, folks, with the photos of the teardown of the phone and everything is just absolutely world class. Alex, that's the heart of it. They're doing 7-nanometer. Apple's doing 4-nanometer, and Apple in September now is going to announce 3-nanometer. What's your belief of their technology speed to get to 654 3-nanometer?
It's really, really hard, right? Because when we talk about the machines that are needed to do this, the extreme ultraviolet lithography machines, they can etch laser patterns that are incredibly small, that sort of 3-nanometer scale that you're talking about. Well, there's one company in the world that can make them, ASML in the Netherlands. But even more significantly than that, there are a bunch of companies in the supply chain for ASML on which ASML has a lock. They're in Germany, they're in Japan, they're elsewhere. Those companies in the supply chain are ones that China also doesn't have access to. So it's hard to get there. Getting to 7-nanometer, it is impressive. They managed to do it, particularly if they've done it at scale with this device. But they are perhaps one, maybe even 2 generations behind.
What do you make, though, of what John was talking about, that this did come out when Commerce Secretary Gina Raimondo was actually touring China? It was a clear question mark. It was a clear statement that it is not affecting us, that you're trying to sanction us and keep us from some of this technology. How far does it go as them as an export vehicle, as a real major competitor on this scale versus just a comeuppance to the U.S.?
Well, when we think about Huawei, the devices, yeah, sure, they're interesting, and we think about Apple, but the real strategic value of Huawei is in telecommunications network equipment, right? They are the biggest player in that space, competing with Nokia and Ericsson. That is something that potentially gives them a huge amount of global influence because they're building the 5G networks in sub-Saharan Africa, in parts of Asia. They have been blocked from the networks in much of the rest of the world. If they can't get the bleeding edge chips for those applications, that is a huge blow to their global ambitions. And it is something that affects their ability to have, for instance, the access to cloud computing, the best 5G antenna at the edge of their network. So that is the real value here rather than in the consumer devices.
Given the fact that China is clearly developing its own technology and wants to prioritize that, there was even this council that was just created to help support private businesses in China. What does that mean for Apple and their Chinese business?
Look, China, it is a symbiotic relationship that Apple has with China. It is not really in China's interest to somehow kneecap Apple because it employs upwards of 1 million people in China, right? So China needs Apple, Apple needs China. the likelihood of that breaking anytime soon seems minimal. Apple devices are still hugely popular in China because they've been building this ecosystem for a lot longer. So is it going to hurt them around the fringes? Maybe. Is it going to destroy their business there locally? It would seem highly unlikely.
Alex, we could have you on for an hour this morning. There's so many stories flying around. John's been so out front on Huawei. I got to stay there. A nanometer, which I have I don't have any sense of what a nanometer is. It's 1/1000th of a meter, 10 to the minus 9. A human hair, John, is 100,000 nanometers. Pull that science over to our worries about defense technology in the Chinese. How do you get from Huawei in a 3 nanometer future over to our worry about satellites and spying and the rest of it?
The real conversation right now around the bleeding edge semiconductors is to do with AI, right? That to be able to do process AI functions with the energy efficiency and therefore cost efficiency that make it worthwhile, you need to be at this very, very, very small scale. And the argument that the US has been making is that doing this is actually stopping the Chinese more broadly from being able to compete in that space, right? Others will say, oh, it's actually just about the Chinese economy as a whole and trying to prevent them from usurping the US. There are a lot of things that China is going to find harder to do when it comes to the AI revolution if it doesn't have the best semiconductors. There's lots it still can do, of course, but the most recent round of sanctions, the US has said, well, actually, we want to ensure they can't get access to cloud computing, right? So it's all very well saying, well, we're not going to let these things go into China, but if China can use cloud computing or cloud servers that are located in, for argument's sake, Singapore, well, then it all becomes slightly redundant. So the US has stopped their access to that as well. It is all about that next generation of AI innovation and what those applications are for.
Just on chips, just on advanced technology, let's just do this in years and sum it up. Alex, how many years behind do you think the Chinese effort is now, relative to where we thought it was?
I mean, look, it's hard because there's so many different pieces to this puzzle.
Sure.
You could say, look, 7 nanometers have been around for in sort of broad, large scale applications for maybe 6-7 years, right? So that's where they are. That's where they've got to. Getting to that 3 nanometer is a lot harder because the hurdle of getting into extreme ultraviolet lithography is massive, right? That is a big leap to get to that point. Lots of people were skeptical that EUV would ever happen. In fact, that's one of the reasons that Intel kind of missed out on it, that they were not convinced that it would ever be possible. It ultimately proved to be the case. There is a long way to go from this to the next phase.
Alex Webb, thanks for the update. The update out of London. TK, this is quite a win for China versus the United States, that's for sure, bottom line.
I think it's a huge wake-up call, and again, the Bloomberg article is just absolutely superb out of our Asian effort, and Alex educate me on, where they are. And my answer is they go from 7 to 6, and then they have this process lithography, whatever it is, where they get to 3. Why won't they be able to do that? They've been doing it for hundreds of years. I mean,
and they do it so quietly.
They
did it so quietly in the last week. Yeah. Secretary comes over there, starts preaching about what they need to change to make the country investable again, and then they just quietly release this, Tom, under the radar.
There's a number of stories here involving politics and that, but just on raw technology, I don't understand how this goes over to our legitimate defense worries about China.
And they are legitimate.
Like submarine telemetry, just talking off the top of my head. I don't know where this heads. It's a phenomenal story. I'll put it out on Twitter here.
Coming up in the next hour, Chris Hyzy of Maryland Bank of America Private Bank. That conversation up next with futures right now slightly negative. We're down by 0.1%.
The distortions in the labour market are gradually wringing themselves out of the system.
The labour market is gradually softening, but not cratering.
This is exactly what the Fed is looking for in terms of getting the normalization in the labour market.
The labour market holds the key to whether you can pull off that soft landing.
Over the course of next year into 2025, I think employment is going to continue to slow. The Fed's going to get its way with the labour market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene all together, back together again. It's back to school. It's back to the real world of equities, bonds, currencies, commodities. 18 stories to talk about this morning. John, real simple. The real yield buttressed right up against the high seen middle of August. I got a real yield 1.94%. That's a ginormous statistic this morning.
High for longer, but maybe not higher. Seems to be the take at the moment. September off the table after the data we had from last week. September 20th, the decision from the Federal Reserve. That may be still hanging, Tom, lingering
When's
around
inflation?
CPI.
13th? Day before ECB.
Of September. So next Wednesday.
Yeah.
ECB on the 14th, next Thursday.
It's going to be an extravaganza before we go to London here. And, I'm sorry, you get an inflation surprise.
Oh, we're making the London announcement.
Well, of course we are.
Okay, don't slip that in.
I mean,
what are we doing over there?
Well, the tots, the schedule, I'm really looking at like Arsenal.
We're going to watch football. We're just going for the North London derby.
Yeah, we're going for the derby.
Okay.
Lisa's going to come too.
Does Bramo know?
Thanks.
Bramo, three of us.
Okay.
Arsenal,
Great.
Football, red. They wear red.
Thanks. Oh,
Everyone
great.
I know.
Bramo's an Arsenal fan.
Yeah.
Everybody I know is for Arsenal.
Yeah.
Over there.
A gunner.
That's a gunner.
Bramo's a gunner too.
Kit Jukes.
There you go. Kit Jukes is also a gunner.
That's where we are. But John, I think
Good to know.
it's a toxic brew of post-Labor Day stories this morning.
But it hasn't been that toxic.
No.
In fact, you would have to say the doves on the Federal Reserve have more ammunition after the data of the last week. And I can share with you some comments from the likes of Mike Gabe and Bank of America saying that the labour market, supply and demand coming into balance a little bit more. Alan Zettner and Morgan Stanley had this to say: the report continues to point to a labour market that is softening but not falling off a cliff, keeping a hike in September off the table in their view. They're not alone. But then you introduce, Tom, and I think this is the conversation we'll have this hour, Goldman Sachs saying 15% chance of recession, that the long and variable lags may well be behind us by the time we get into 2024. Neil Dutter of Renmac, that conversation 28 minutes away. He's talked up an economy that's outperforming, above trend growth, that could well reintroduce inflation reaccelerating at a Fed that may well have more work to do.
But Lisa, if it's not 15% recession, it's 85% what? If I did the math right.
There's a theme emerging this morning, and I think that it's not a toxic brew at all. It's the opposite. But there's a question of what this looks like. And we heard from Steve Chiavarone of Federated. He's bullish on U.S. equities because it's the area of growth. And then we heard from Katie Kaminsky that this could mean that bond yields are higher for longer. You put these two things together, this idea that you don't necessarily need to see the Fed cutting rates anytime soon because the long and variable lags aren't that long, aren't that variable, like Goldman Sachs had to say. So that leaves us in a new rate regime, and people are sort of going back to that idea.
Overcome by events. Katie Kaminsky, I adore. I love her trend-based work. John, 88.41 on Brent crude, and she made clear that's a trend. Alpha sites, whatever it is, they're
Alpha
looking
Simplex.
at. Alpha Simplex.
Alpha
What's
size.
it? Alpha. They made.
You two get this settled, and then I'll jump back in.
Semiconductors.
Okay, oil. You want to talk about
oil,
Brent?
Brent crude.
Do you see the move in crude as a reflection of economic improvement? This expansion going longer than expected, or a reflection of what's happening on the supply side?
I look at it as
if it's the demand side.
Post-COVID.
Okay, if it's the demand side, Tom, then maybe you can make the argument the Fed might have more work to do here. If it's the supply side, then it might be the recipe for a slowdown regardless. I think how you frame this, Tom, is important. The move in the last week, lots of people might say that's down to Russia cutting back and maybe the Saudis set to follow going into OPEC. But, Tom, I'm with you. Iron ore back to April highs.
Exactly.
Crude's
Thank you. I looked this morning.
There's a lot out there on the commodity side
How do you
suggesting
search for
that
iron ore on the Bloomberg? You just go iron ore?
It used to be Tianjin. It used to be a different... I used to look at a different benchmark.
I agree. A different benchmark. But let me open this up because I didn't get to ask one of our guests this. What's the gloom trade right now? What's the weight of people gloomy on the market? I can't get a handle on that. I mean, how many people are gloomy on the stock market?
So Jim Bianco of Bianco Research is going to join me later on the bond market in about 55 minutes.
Yeah,
and what is consensus right now? Jim believes consensus in the bond market is still bullish, long, yields lower.
Yeah, and we heard some people pushing against it. But
he thinks you should lean the other way.
What's the gloom bet right now in the stock market? I don't have a handle.
There are people who come out and say that there isn't one, and that's been a problem for them, that they'd like to see more baked in. And then others say, if you look at the options market, it's not as rosy as people previously expected. So there is enough gloom to make some people bullish even further.
We pulled back when you guys weren't here Friday from a 13-level VIX to 14.19.
This is market roulette this morning, TK.
It is. I mean, the VIX is 14.19. I mean, it's gloom out there.
I'll throw the euro at you.
Thank you.
Euro just about holding on to 107 at the moment. So 107.34.
I agree.
Near session lows.
Right now,
0.6%.
Our guest is so important. We've got to get to him right away. James Karen is CIO of Portfolio Solutions Group at Morgan Stanley, with decades of experience on his bond market, and also it folds into everything else. Jim, we're playing data roulette here, as John puts it, this morning. How do you interpret Brent crude on the edge of a moonshot up to near $90 a barrel? How does that change your world?
Well, I think, when I think about oil, I always think about the demand that goes into it, right? So is this a sign? I mean, clearly there are technical indicators for oil in terms of supply and demand. All that stuff goes into it. But could it also be that global demand isn't as soft as people think? I mean, yes, things are slowing down, but could it be that the production isn't enough to actually sustain a softer landing, whether it's in the U.S. or even globally? Yes, things are slowing, but they're not collapsing. And I think that's the key. And I think that's one of the things that's probably going to be somewhat supportive of oil, that plus some of the technicals in terms of the undersupply.
Jim, let's talk about the equity market. You cover that now too. We spoke to Steve Chiavarone of Federated Hermes. He reckons this rally has got legs. Do you share that belief that maybe this rally has got legs? I remember conversations that you and I had at the start of the year, and we were talking about risk, and you made the point that downside risk is something we're all talking about. Upside risk is something we need to appreciate a little bit more. What about now, Jim?
Yeah, I'm still in that camp. I mean, look, I want to be very clear. I do think the economy there is a slowdown that's underway, that there's no question, but I don't think people are positioned for it. And I think that's one of the real key factors, meaning that when we look at equity positions right now, positioning in equities, I should say, isn't necessarily overly long. So therefore, the market's vulnerable to move higher on modestly good news or less disappointing news. So look, take 2Q earnings. 2Q earnings were supposed to be down 7%. They came down to 4%. Okay, that's not a good number, but it's a lot better than where it was or what people were thinking. And if we think about the third quarter earnings might be flat to slightly positive. This could be the inflection point. And this is something that investors typically like to buy into when there's an inflection from negative earnings growth to potentially positive. So, and given the fact that people aren't overly positioned long in equities right now, then I think that there could be some possible legs as long as we don't get the disappointment.
Well, what disappointment are we really talking about here? Are we talking about the disappointment in earnings? Or are we talking about the disappointment that, if growth can continue to keep chugging along, even with yields where they are, maybe yields can stay here for that much longer and even go higher, the Katie Kaminsky view of the world?
Yeah, so that's a great question, Lisa. So I think you're right. I mean, it's the disappointment in the growth, right? So right now, everybody's focused on, a recession, an upcoming recession that's supposed to happen. Yet, third quarter GDP estimates are being upgraded, not downgraded right now. So, okay, we may be slowing, but we're also getting some pretty good tailwinds that tell us that the slowdown in the potential economy, going forward into the fourth quarter and maybe into early next year might not be as bad. So I have a lot of sympathy for what Jan Hatzius at Goldman Sachs is actually saying, which is that you could have a softer landing here. And I still don't think people are positioned that way. So something that John and I was speaking about at the beginning of the year was that risk on is a risk, and like any other risk, it needs to be hedged. And I don't think that people have enough risk in their overall portfolios in terms of the balance of equities relative to fixed income. I still think that, people believe it's the year of the bond market and that bond yields are going much lower. I kind of lean against that too, sort of like my colleague Jim Bianco does. I think that we could be getting a little bit of a push higher in yields.
Okay, so this really is the question. If you believe in Jan Hatzius' view of the world, you also believe that the long and variable lags has been overplayed and that that's actually not really going to factor into any kind of slowdown, that what you see is what you get in terms of the strength?
Yeah, so that's where I push back a little bit on that call. So essentially, the fact of the matter is that interest rates are high. Financial conditions in that sense should be tightening. I mean, certainly the banking sector and what have you. So it's not like that just goes away, right? So it's not like those long and variable lags in that sense go away. But the long and variable lags in terms of whether it could be potentially employment, it could be growth in other sectors of the markets, particularly the value sectors of the markets, those sectors could actually stand to do a lot better. So while we're looking at very sector-specific areas like growth and technology, which have done very, very well this year, certainly those may still get impacted later on. But I think the broader sectors of the marketplace, like the materials, the industrials, and even some of the consumer staples and discretionary, could actually start to do better.
Jim, just quickly, November hike still in play?
Not in my mind. Not at this point. We would have to see some change in the data.
Okay. Jim Caron there of Morgan Stanley. That next big data point, September 13th, a week or so away. Just going into that ECB meeting on the 13th is the CPI report, Tom. September 14th is the ECB meeting.
Well, we got a whole bunch of dates coming up here. We got September 13th CPI, September 14th ECB. More important, September 17th, Formula One in Singapore.
Nice.
Which will be interesting as well. Then we got the 20th, which is FOMC. And, I think Arsenal we can make. The three of us would be great.
Is that the 24th?
24th, sort of
something
on the way
like
to
that.
Heathrow. And then the 30th is Liverpool is at Tottenham.
Didn't know that. Okay.
Today is like the 104th, whatever, anniversary of the advent of the Tots. So,
Are you celebrating?
Well, no, I was going to take the day off and celebrate, but I got to be out tomorrow. I Afterthought starts school tomorrow. So,
Okay, so you're taking tomorrow off?
Yeah, you walk. Well,
so you like drink
actually,
tonight and
you don't walk
toast
them
the
to
club?
John, you don't walk them to school anymore. They walk 6 feet in front of you, so they're not with you.
Well, when they're teenagers, that tends to happen, Tom.
They walk like 15, 20. Hey, you.
I think it's sweet you're still walking them to school.
It's
that's
very
very
sensitive.
sweet.
Yeah.
That's very kind.
She's got a lifetime pass.
No. Grandma will be here.
Yeah, I will be here for the first day of school.
On your way, children.
100%.
If you're just tuning in, welcome to the programme. The S&P are negative here by 0.1%. Coming up a little bit later, Neil Dutt of Renaissance Macro, 8:30 Eastern Time. Tom, 17 minutes away, just defying the gloom, the doom in this economy. Neil's call all year.
Whether you are cautious or not, this is the conversation of the day, as Mr. Dutta rephrases his brilliance of 18 months ago. He really was extraordinary. He was lonely.
But he's not lonely anymore.
Not lonely anymore, no.
Not lonely at all. Coming up in the next hour on Bloomberg TV, going into the open and bow, Jim Bianco of Bianco Research, Stuart Kaiser of Citi, Tiffany Wilding of PIMCO. PIMCO early this year, the middle of this year in June, put out their secular outlook, and led by the former Fed Vice Chair, Richard Clarida, talked about tolerating 2-point-something. 2-point-something and tolerating that inflation level, Tom, I think has quickly become the consensus view amongst a lot of people going into year-end and into next year.
The former vice chairman leading on that, and I'm going to go back to the 10-year yield as the barometer, the real yield 1.95%. Ian Lingen has it up 2.0-something% is maybe his upper bound. History says we get back to that. There's a raging debate about what the real yield does here in the Q4.
The question is, particularly going into an election year, is this Fed willing to destroy the labour market to get inflation down 100 basis points? That's still the question, isn't it?
Yes, it's still the question. Andrew Hollenhorst was brilliant last week when you were not here. And, the fact is, I'm looking forward to Stuart Kaiser. I think
just be clear, you're killing me for taking Friday off. You're off tomorrow.
I'm off tomorrow.
Okay, and I will miss you. From New York, this is Bloomberg.
We want to connect this inflation story. The thing we're watching is the oil market. The reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
On fire this morning, Katie Kaminsky really talking up the trends that she and Alpha Simplex see, and as we mentioned here 10 minutes ago, really extraordinary her view on the trend base of oil. Right now, let's quote that for you. American oil, so it looks like it's a Brent price, $85.29 on West Texas Intermediate, $88.38 with a dash near 89 earlier this morning. I'm Brent Crude. Lisa, you and I were talking about this on the break, and to me, it's the story of Q4 that's undermodeled right now is how I'd put it.
I could not agree more. Honestly, it's not just the oil sector. We've talked about some of the other commodities as well.
John mentioned iron ore.
Iron ore, also food. And you've seen this in emerging markets really creep up where food costs are going up significantly. At what point does that challenge the idea of this disinflation in the U.S. if you have gas prices, if you have oil prices climbing at a significant pace?
Yeah, I want to mention right now along that line, as you mentioned food here, my book of the year has just come out in the last week. It is hugely anticipated. This is Robert D. Kaplan. He's had my book of the summer and book of the year before, and he is absolutely exquisite on geopolitics. It's the loom of time, and I just really can't say enough about it. I put it out on Twitter last night. I'll do it again here.
Especially at a time where you see rice in Southeast Asia, prices climbing back toward the highest in 15 years. Just a changing dynamic around the margins that isn't getting talked about a lot. Maybe it's just because of the supply side. Either way, what that does going forward could shape at least the next couple of months.
Right now, we're going to frame out your next couple of months. There's a loom, Robert T. Kaplan, The Loom of Time, folks. On radio, it is absolutely brilliant, 300-plus pages, a tour de force by Kaplan. You know him from Marco Polo's World from a number of years ago. Right now, on the equity markets, we frame it with Chris Hyzy, Chief Investment Officer of Merrill and Bank of America Private Bank. Chris, I love your note. You've got to participate, but you're scared stiff. How do you participate in equities if you're scared stiff?
Yeah, I think you have to first start with a plan. You can't go into anything where there's a lot of cross currents without a plan. So you also almost have to have an understanding that you're going to have a lot of choppiness in the markets, particularly when you've got cross currents, whether it's inflation, the energy markets, food prices, the labor market, which is now normalizing again, and almost back to normal, frankly. And then finally, you've got a slowdown in China. You still have the war in Ukraine. There's so many things to fear. So you want to look at weakness in the markets, use it as a dollar cost averaging approach. We call this a market environment overcast. It's not sunny. It's not raining. And those are the markets that kind of, dismay you. They make you stay on the sidelines longer than you should. So have a plan, be ready. And in particular, you shouldn't be underweight equities at this point in the cycle. That's our plan.
What point in the cycle are we, Chris?
Well, that's a good one. It's blurred lines between late and somewhere in the limbo part between late and early. We're all waiting to see the signs that the Fed is done. But unfortunately, when the Fed does cut, they usually cut for a reason. And that's usually because growth is coming down sharply. The labor markets have already peaked as in terms of employment. And then ultimately, they have to do something. So everyone's thinking that that's going to be in the spring of next year. We don't really know when it's going to be. No one will know until the data starts to pull through that way. And at that point, that's when you should start to see earnings begin to discount something better on a second half of 24 basis. But markets don't wait for that. We all know that. So the second or third cut is usually when markets begin to climb that wall of worry. So between now and then, we're in limbo, and that's like a late cycle type of move.
And we are seeing right now, at least according to some estimates, that Wall Street is raising quarterly profit earnings at the highest pace going back 2 years. So that's sort of where some of what you're talking about does come into the fore. That said, is there some sort of incoherence here with this idea of betting on rate cuts at a time where growth is continuing to chug along? We've got concerns about commodity inflation, and a lot of people are saying higher yields for longer seems like the most likely outcome going forward.
That's such a great question, because this is the whole issue that's going on and why there's still so much cash at the short end of the curve. This is not a normal storybook. The distortions coming out of the pandemic and through the pandemic have basically balanced out a lot of the things that would have normally happened. So you've got this overage in some places, and then you've got this slowdown in China mixed with whether or not the Fed is going to continue to keep real yields where they are or actually expand them. So for what it's worth, I think the earnings side of the equation, most of Wall Street believes that the second quarter was the trough. Our view is going to be it's going to be a bumpy earnings progression. And then ultimately next year, you start to grow again for real. This point in time in the cycle, you generally get better economic numbers right before you don't.
Chris, I want you to address a traditional 60-40, or dare I say 60-30-10 allocation and the partial differential of cash right now. Now, buttressed against that in the equation is a 5% yield on cash, money market, whatever. But how do you utilize cash as a tool to get out 3 years to that equity optimism?
Tom, that's perfect. Cash at the short end should be used if it's investable. In other words, if you're waiting to invest those dollars, that cash, 5.5%, should be viewed as cash flow for investment. So if you get weakness in September, which you typically do, right around potential worries of potential government shutdown, use that cash flow into the equity markets, particularly if you're underweight. And then over a 2 to 3 year period where earnings are now back on track, they're growing again. Yeah. The economy is away from the distortions. So we use that as a tool. That's a very good way to think about it.
What do you say to people that are just downright cautious on the market? We have coming up, folks, in about 25 minutes, David Rubenstein, and we will talk about the wonderful Jeremy Grantham of GMO. And Jeremy Grantham has been really, really cautious on stocks for a really long time. I'm going to call it 3 years. How do you address those people and say, you got to participate if you want to retire, if you've got goals down the road?
I think number one, I think it's important to understand that all different types of cycles have different catalysts to them. They may be core in their nature as to how it works, how money flow works, from one asset class to another. The relative movement of yields relative to the earnings yield in the S&P, all those things are fundamentally fine as it relates to how to think about it. But there's major drivers of this new economy. I would argue that the innovation cycle in this new economy, and even in the last decade or so, constantly reinvents itself much quicker than ever before. So you can go into a new profit cycle much quicker. Therefore, the valuations in this type of market almost have to be higher than traditional cycles of the past, where you didn't have the same innovation speed that you have today. That doesn't mean it's completely different, but it certainly means that there's always something to worry about. And usually when the worries are so high and those worries don't pull through as large as you expected, you get a good market.
Chris, thank you so much. Chris Hyzy with us with Merrill and Bank of America Private Bank. Lisa, to go from Jim Caron, who I thought was fabulous across asset, to Chris Hyzy, who's talking to people, what do I do forward, whether they did get the bull market of October or the 2-year bull market, and then to go to Neil Dutta coming up, who's an outright optimist. It frames people that are almost frozen, and you got to say, let it go, you've got to invest. But the percentage of people out there frozen right now is substantial.
None of those people were frozen. They were saying you need to own bonds, you need to own stocks rather, and you need to go in.
But that's their
more
job. I mean,
significantly.
come on, they're talking their book.
Well, to some degree, but you heard earlier this year, be cautious, be cautious, be cautious. Cash is good. And now you're not hearing that. You were saying earlier, why can't some of these stock bulls get some love? They are everywhere. I think it seems like a lot of the strategists are saying it seems like this does have room to run. I just think it's a confusing economy right now. I don't think that anyone really has a handle on exactly which cross current's going to win out.
Shout out to our team for a set of great voices as we come back from summer. Bramo's back. Summer's over. It's time to get down to business. We've got some great voices. Neil Dutta coming up as well. Stay with us. Futures, -10. Good morning. Bloomberg Surveillance, and we say good morning to you, good September to you, good back to school to you. It's sort of New Year's. I've always felt that this is New Year's. Maybe not now. Maybe it's Wednesday or Thursday, or
when the kids actually leave.
With a new thing, September 15th. We're going to be going off to London. We are thrilled to tell you that Surveillance, the entire team, we got 40 people on a plane. They're actually on separate planes. Lisa, John, and I can't travel together. That's part of our agreement. There's too much risk. But we're all going to London. It's like 40 people, and we're just going to have a hell of a good time talking to British voices. And this comes off, I believe, we were on the plane the day after the ECB meeting, so it'll be interesting to see.
Yeah, immediately to get on-the-ground response to what Europe is doing, even though that's not the Bank of England. Team coverage of ECB decisions and what we do with the Bank of England.
It's going to be interesting to see. And over the weekend, there's so much news over the weekend, Lisa, but one of the things I saw, and I thought the FT coming out of London, not on Labor Day, did a great job on this, the miss on growth in the United Kingdom was biggish. It was demonstrable how much better the United Kingdom has done versus the gloom that was out there a year ago.
Did you see services PMI coming out today of the UK? It was very different than what we saw out of the rest of the European region because they actually outperformed. Look, I just really can't say enough that Diane Swank on Twitter, when she came out and she said, I am humble enough to know what happened these last 3 years was complex and interrelated in ways we will be figuring out to a long time to come. This is a complicated moment. We hear about tech innovation. We hear about some of the psychological impacts from COVID. We think about the decoupling of global economies. You put it together and you have a stew of uncertainty that's leaving a lot of people thinking maybe we're even starting a new economic and market cycle.
Or given the shocks you mentioned, a partition between the tech haves and the after COVID haves.
Yeah.
And on the other side, half of America, as a generalization, flat on their back, even given a 3% GDP, which is ample, is quite good.
What do you do with that, right? The people who are getting massive wage increases. Well, and this is going to be a really important question. How has the economy really left some people out of the workforce in a material way and in perpetuity?
And perpetuity was October of last year when all of us were gloomy. Even I was gloomy. Bram was leading the charge on that and dead on into the really difficult September of 2022. And then there was something in the air. In the equity space, we heard it from the technical analysis giant, Ralph Ancampora, Edward Yardeni of Yale, CJ Lawrence is his own shop. On top of it, get into the stock market in October of last year. And on the economic side of Y equals C plus I plus G plus NX was Neil Dutta, very lonely, at Renaissance Macro a year ago. We're really coming on a year ago, Neil, from your Arch call. Let's review. What did you see in September of 2022?
Well, thanks for that intro, Tom. You always make me look better than I actually do.
Yeah, we try.
So I appreciate it. But, I think for me, it boiled down to something very simple, which is wage inflation was hanging in there while price inflation was coming down. I mean, that was the principal risk to the economy in the spring of 2022. You had a very aggressive Fed. You had rising food and energy prices that shocked household incomes due to the Russian invasion of Ukraine. Of course, as we got towards the end of the year, a lot of that shock had gone away while the labor markets were still kind of hanging in there. So real incomes were climbing. And that meant stronger consumer spending ultimately. And that's why the economy sort of there. And of course, remember early in the year, Tom, everyone was betting on a Fed pivot. And we saw a we saw a modest decline in mortgage rates as a result of that. But that modest drop elicited a fairly robust response in housing market activity. So there's a lot of pent-up demand there for housing. And so I think, when housing is working, it's difficult to be very bearish on the economy.
If we have disinflation or leveling of inflation, what does nominal GDP do? Because top-line GDP, your real GDP optimism with whatever inflation is, linked into revenues of corporations. What's the Dutta nominal GDP call?
I mean, it's at least 6%.
Wow.
I mean, if you believe the last employment report, when you look at aggregate weekly income, aggregate weekly payroll, sort of the sum product of jobs, hours, and earnings, over the last 3 months, that number is up 7% at an annual rate. So, the labor market sort of impulse for nominal growth is quite strong as well. So we have an unsustainably strong economy still. And this is happening at a time when the Fed is taking, steps to the exit door. So, to me, I think the risk, and this is what I think makes me not an optimist, is that the risk is that, the Fed is prematurely declaring victory. I do see a lot of cyclical momentum in the economy right now, and the Fed stepping back. I think that could set us up for a problem as we go into 2024.
Neil, the fact that you said an unsustainably hot economy, an unsustainable level of growth in the U.S. raises this real question. What's going to make it unsustainable? Is it the inflation story that you see as resurging? We've talked about this before, and the fact that the Fed's not there, or is it just that you cannot continue in a vacuum? So at some point, it's going to implode on itself.
Well, I don't know that it'll implode on itself without the Fed doing something about it. And of course, the problems for markets are always when there's a disconnect between what the Fed wants to do and what they should do. That's when the problems come up. And, I think the Fed should not be signaling rate cuts next year. I mean, that to me is a bare, that's like a easy first thing that they should do, is not signal rate cuts. They need to maintain a tight monetary stance because, frankly, real GDP growth is running, last I checked, 6% at an annual rate over the last 3 months. Now, you can talk about revisions, you can talk about, that's not where the underlying growth rate is. But if you look at monthly GDP as of July, over the last 3 months, ending in July, it's up 6% at an annual rate. I know that's not the underlying trend, but it's above trend growth.
Well, and this is the reason why a lot of people are talking about the same thing that you are. We heard from Katie Kaminsky over at Alpha Simplex basically saying the same thing that you are in different ways. And she's bearish on bonds because she sees this coming to the fore and yields having to remain higher for longer. There is a question, though, embedded in Goldman Sachs's discussion of the long and variable lags. And maybe this is an economy that can shrug off a 5% Fed funds rate, and it's not going to matter. So at what point do you see higher bond yields as not inconsistent with higher stock prices, with higher valuations, with a continued rally in the equity market?
Well, I mean, I think right now the combination is reasonably good for stocks, right? Because the Fed is backing off and you have strong growth, and that's so the Fed's sort of off your neck, I think, at least through the end of the year. I mean, if they're going to hike again, it'll probably be in December. So I don't really think we have to worry about the Fed until then. And this is happening at a time when there's cyclical momentum in the economy. The fact is that goods spending, consumer spending on goods, is up over 3% against last year. And during that time, non-farm inventories have been contracting around 0.5 percentage point on average per quarter. Again, that's an unsustainable drawdown in inventory. So what are you going to see? You're going to see inventories restock. That's going to buoy manufacturing production. Again, cyclical industries. So that should be good for equities. The question is, when does the Fed wake up and realize that long and variable lags are not working out as neat and cleanly as they have in the Furbis model?
Based on the 6% concept,
they may have to step on the brakes even more so.
What does that mean, right? And that's exactly where I was going to go. How high do rates have to go in order to curtail some of what you see as unsustainable growth in the U.S.?
I mean, to me, I think that you need to keep the possibility on there for them to start to hike again in the first half of next year. At a minimum, they're going to price. I mean, I think they have 4 rate cuts priced into the summary of economic projections right now. It's hard to see that surviving in September. So, I think let's start there.
Neil, in the economics textbook, chapter 23 or 24 links all of this econobabble into the stock market. Take the data optimism, and the corporations are going to have to deal with an improved real rate. They're going to have to deal with a high nominal rate, out 3 years, 5 years as well. How does the stock market respond to that? How does the stock market react to an overweighted, optimistic data world?
Well, so I think you could call it sort of an inflationary boom. I think that might be what we're returning to. And if that's the case, that's an environment where stocks can work. But it's unambiguously bad for bonds. But for stocks, I think it's an environment where you should see continued positive returns, maybe not, somewhat below the historical norm. Obviously, if you have higher real interest rates, that hurts equities. But if you have continued growth in the economy, that means that actual and projected earnings will hang in there. So
just because of time, Neil, I got to get this in. How is an inflationary boom different now from the horror of the 60s?
Well, that was obvious. Well, the horrors of the 60s. I mean, the 60s were a reasonably good period for stock market returns and the economy. An inflationary boom, again, as I say, is something where equities can work. What you don't want is stagflation-like conditions, where productivity is coming down, where you have repeated supply shocks. That's an environment where bond returns are horrible, but stock returns are as well, because companies can't find a way to make money in that environment.
Neil, your Q4 GDP number right now. We got to get Bramo going. What's your Q4 real GDP number?
I mean, we're running so strong right now. I mean, but I think we probably slow to something like 2.5 in Q4. I think what the consensus is missing right now is that we're going to have a very robust inventory restocking on our hands. That's going to bleed into measures of factory activity.
Neil Dowda, congratulations on your economic work. He's with the Renaissance Macro Research as well. So there it is, Lisa. That's the glass half full feel. And, well, yeah, I think it is. I mean, it's a guy looking for legitimate economic growth. I don't think it's just not stagflation. If you got a 2-3% GDP pop, 1%, yeah, you got my attention.
One of the tensions, though, that we've seen all morning is that there is this optimism that the U.S. equity market can continue to rally and that the U.S. economy can continue to grind forward. What that means for the bond space is a very different story in terms of how high yields will go, how high yields will stay, and what that will do longer term, not only for the Fed action, but in general for companies as the price gets more expensive and as they start to just throw in the towel and raise debt anyway.
Day after Labor Day, up 5 basis points. Standard & Poor's 500 futures up 0.3%. Much going on here on a Tuesday as we plow through the week. I guess it's a quieter economic week after the festivities last week, but nevertheless, a lot of cross currents and stories today. I think we got to go back to the Pacific Rim, and barely mentioned by us today is yen weakness. And over the weekend, I'm sorry, I can't remember who it was, had a real nice inflation pain story in Japan. 3% inflation for the Japanese is a shock.
Well, household spending has been going down as a result. Potentially, that's been one of the connections that people made with some data that came out over the weekend. When you talk about the Pacific Rim, I think coming up later this week, we have the G20 over in New Delhi, over in India, and we aren't going to see Xi Jinping there. And that, to me, is interesting because of what Damien said. In and of itself, who cares, right? But, when it comes to this question of where the allegiance is of India and China, how closely connected they are at a time when China seems to be moving away from the U.S. and Europe, that's interesting to me.
And how the U.S. participates in that dialogue. I mean, I was thinking actually of John Kenneth Galbraith. This is a few years ago. I'm thinking 40, 60 years ago in India. And we have all these legacy thoughts of India in America, most of them ancient and dated and silly. It'll be interesting to get a brief there. And of course, our team in Bombay and New Delhi leading our coverage there of the G20 meeting. This is incredibly well timed. Coming up, David Rubenstein talking to any good number of people for his show, Bloomberg Wealth. David Rubenstein, I want to touch on the caution of Jeremy Grantham. From New York, after Labor Day, this is Bloomberg Surveillance.
I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the Great Bubble.
Jeremy Grantham of GMO, generous in his charity. He's really had an interesting time here with his caution on the stock market and equities as well. An important conversation. Look for this tonight, 9 p.m. Jeremy Grantham of GMO Boston in conversation with David Rubenstein, Bloomberg Wealth, 9 p.m. Tonight. Lisa Abramowicz and Tom Keene getting your autumn started. The leaves are changing in Central Park. I put out an Emily Bronte poem for John Ferro.
Yeah, I saw that.
The joy of the leaf's changing.
Yeah, it was sort of, racked with angst and pain.
You were up north of Tupper Lake this weekend.
Yeah,
I mean,
yeah.
the leaves are already going big time.
Yeah, full time, like big red trees. And I saw a red leaf fall, and I kind of
burst
teared
into
up.
tears and all that. Right now, we're going to burst into tears with David Rubenstein. He joins us, of course, of the Carlyle Group. His philanthropy, including completely stacking the Duke football. We have to stop the show after talking to guard Jay Pulaski. Duke 28, Clemson 7. How did you contribute to this win?
I was calling the signals in from the sidelines. and people didn't know
with
that.
Your
I had little hand
Duke.
signals, and that's what Duke did. If they'd listened to my hand signals earlier, they would have been a better team all along, but they just started listening to them.
Is this Rubenstein making Duke football a new D1 resurgent story?
It's great. We haven't had victory as big as this in quite some time.
What kind of hand signals? Like, woo!
Well, that's how Coach K won all of his championships. I would send in hand signals from the sidelines. He didn't want to tell people that.
Yeah. David Rubenstein, Jeremy Grantham. I know Jeremy for ages. I have huge respect for him, and his philanthropy speaks volumes. In your conversation with Mr. Grantham, how did you address the 4-year caution he's had on the American financial experiment?
For those who don't know, Jeremy Grantham is a man who is a very distinguished an analyst, financial analyst, and he's been quite prescient in predicting bubbles bursting, and he's really good at that. And he's predicted many bubbles that actually subsequently burst. As a result, he's got a really terrific record as an investor. But now he's spending most of his time investing in climate change and climate tech. He thinks the greatest challenge in the world now is the climate problem we have. So most of his money is in a foundation that goes towards that. But he likes to call bubbles, and he's said maybe artificial intelligence is a mini bubble. But we're now coming out of the tech bubble, and that tech bubble he forecast, and he was not involved in tech, and therefore he did pretty well for his investors. He built GMO many years ago. He's a British citizen initially, but lived in the United States after Harvard Business School. And he built one of the better money management firms in the Boston area. And he's quite well known for his philanthropy, but also for predicting bubbles. And he also says the Fed is almost always wrong in predicting recessions. The Fed is not predicting recession now, but he thinks we will have a recession for sure.
Does he think that it's harder to see a bubble now than in the past? Is it more difficult to spot bubbles in an era where people have been grown up, have been raised through the financial crisis and through the Big Short and all the glory around bubbles?
Well, you don't really know you're in a bubble till it bursts, typically. And he's actually pretty good at predicting bubbles, but nobody's perfect at it. And the reason we have bubbles, he would say, is that there's the phenomenon that everybody is afraid that their neighbor's going to get rich and they're going to miss out on it. So they pile in when things keep going up, and ultimately, in a burst, they're disappointed. Pointed out, for example, Sir Isaac Newton, one of the smartest men ever, he got into an investment, thought it was pretty good, doubled his money, got out, and then he saw it kept going up and up. So he mortgaged his house, took all of his money, put it back in, and he lost everything. He went bankrupt.
Physics and market timing maybe don't go exactly together all the time. I'll just say that.
Right.
But there is this question going forward, especially at a time where people are trying to game out where the Fed is, of just the cross currents and the uncertainties and how much the U.S. can continue to diverge from other places. Does he seem to think that that's overplayed based on the AI bet, that sort of people are not looking at history and that they need to more to really understand this?
Well, I think looking at history would be something he thinks is a good idea, because if you look at history, you'll see that when you have these kind of inflated bubbles, inevitably they're going to burst. And so we've had many bursts. The dot-com bubble is where he really made his name, because he was, in effect, predicting that would happen in 1998, 1999, and 2000. And his firm did quite well, avoiding the tech bubble that existed then. He's actually a legendarily smart person about predicting follies of the markets. And he's not afraid of telling you that you're not smart, you're stupid, you're doing something wrong. He's not afraid of actually going against the conventional wisdom. Very often people don't want to offend other people by telling them they're not that smart, but he's willing to say, you're wrong about this.
But this is why this conversation is so important, folks. 9 p.m. tonight, Rubenstein, Grantham. David, you're one of the congenital optimists out there. You have put money where mouth is on the artifacts, the heritage of the American financial experiment, the Magna Carta purchase that you made, and the others. I'm not going to say you're the polar opposite of Mr. Grantham, but there's a built-in Rubenstein optimism. Do you maintain that even with the, not perma-bear, but the perpetual caution that we witnessed with Jeremy Grantham?
Well, he's much more bearish and much more negative on things than I am personality-wise, probably. But, you know, that takes a lot of courage. When you're telling people they're wrong all the time, that's not easy to do. So I'm probably not as good at telling people they're wrong to their face as he is. But he's willing to tell people you're wrong and you're making a big mistake.
All of us rocked by the climate change stories of the summer, this, that, the other thing. What is his prescription to have America address facts of climate change?
Well, he thinks we're not doing enough, for sure. Now, he can't solve all that problem himself, but what he's doing is taking most of his money now and investing it in green tech companies, venture capital kind of companies, small ones, hoping that one thing will come along that will actually make a big difference. But he's not trying to influence our government policy by going down and lobbying. He's past that. But he's actually a very, very clever person who now has made his main focus in life climate tech and investing in things that are going to maybe help with climate.
You've said several times he's not afraid to tell people to their face that they're wrong. Has he said that to you?
Well, he hasn't said to me I'm wrong, but necessarily. But I think generally, when you're predicting people, or you're predicting bubbles are going to burst, you're telling people 90% of the people they're wrong, and he's not afraid of telling people they're wrong. You got to have a certain kind of personality. Probably he's better at it than I would be.
The idea of investing in niche companies, sort of what Tom was talking about, whether it's climate change or whether it's some of the venture capital that other people are doing. Is that a more sure bet from your point of view now at a time where there is such a high degree of uncertainty on a macro level?
Well, on climate tech? Or
just in general, broadly, like this sort of niche concept of just going at things very specifically with a smaller pool of money. Is that a sure bet to make bigger returns?
There's no sure bets anywhere, of course. I think the biggest concern that I would have is that we're not quite past the point where we know there's not going to be a recession. I don't think we will have a recession, but nobody knows for certain. You don't know it until you get into it. Right now, the conventional wisdom in Washington is that we've gone past the likelihood of a recession. And there are some people like Jeremy Grantham who thinks that we may have a recession, but it may be next year, not this year. As you know, there was a prediction of a hard landing, maybe by the end of this year, but now most people would say probably not going to have a hard landing by the end of this year. But as the next year, that's when Jeremy Grantham thinks there will be a recession, sometimes next year. And again, predicting recessions is a fool's errand. It's very difficult to do.
Dave, I got time for one more question. It's really important. The quarterback for Duke is just totally irresponsible. He had late homework, and he had to do a whole video asking the professor to delay his, to get his homework in so he get a quality C. Riley Leonard of Duke University. I mean, is he destined for a Carlisle internship? I mean, where are we on this? I need to make some news today. Help me.
Well, I think in college football and college basketball today, you can make more money playing college basketball and college football than going to a private equity firm.
What did you think of the Citadel internship? The salaries they're getting? Did you see that last week? They're making ginormous money.
Well, Citadel is a great firm, and it's got a great leader, and they're making a lot of money, and I guess they're paying out a lot of money. They want to get really smart people, and they can pay up for it.
But what was your first internship in finance? Where you walked in the door and said, "I'm just glad. Can I get you?"
I didn't have an internship in finance. I think my first job was probably selling magazines door to door or something like that. But I didn't have a finance internship, really.
David Rubenstein here. Riley Leonard, if you're listening to this morning, call 1-800-RUBENSTEIN and you get that Carlisle internship going. Duke, I mean, it's exciting. It's college football season.
Yeah, it is. And that was quite a game that they delivered. I'm sure they'll be hearing a lot about it in your next hour with one Paul Sweeney, who might be very excited.
He will, but Colorado Buffaloes, Ralphie comes out in the field. It's like a real buffalo. Comes out in the field. Deion's going, recruit him. We can have him as a defensive tackle.
Yeah, we could bring him in here.
Buffalo's beat TCU. It's very, very exciting. Tonight, rather this afternoon, I'll get it right. Tonight, this afternoon, actually a really timely conversation. Lawrence Culp, GE Chief Executive Officer, an update there, to say the least. 1:30 this afternoon. This is Bloomberg. Good morning.